Welcome to Yahoo Finance Live on this Wednesday, September 20th. I'm Akiko Fujita along with Josh Lipton. We are awaiting that Fed decision, just moments away from hearing from the FOMC and their policy decision with interest rates there. Let's take a look at where the markets are ahead of that decision coming down. It is the Dow up more than 200 points right now, the S&P 500 up 8, and the Nasdaq holding pretty flat, down just slightly there. Treasury yield certainly going to be in focus as we await to hear from Fed Chair Jay Powell. Take a look at the 10-year yield there, retreating from that level we saw yesterday. Yesterday, we saw that reaching a level we haven't seen since 2007. Today, it's down more than 1%. We're talking about 4.32 right now. Now, Josh, as we await Jen Schomburger over at the Fed to break the news here, we are not expecting a decision, or at least a change in the interest rates, but the summary of economic projections, where the Fed sees the economy going, certainly going to be in focus, in addition to the Fed chair's comments.
Yeah, this is the big day. This is the one we're waiting for, Akiko.
It's your first Fed day.
It's huge. I'm doing it with Akiko. Perfect. I think a couple things. One is obviously, listen, bottom line, core inflation we know running way above where the Fed would like it to be still. So they don't think that inflation fight is over. However, I think a lot of people are thinking, take a pause, take a breather. You've taken rates up hard and fast already. So maybe it makes sense here. Let's wait. Let's see what the full impact of what we've already done has been. Is that enough in and of itself to fully derail inflation?
Yeah, the market is largely priced in a pause for at least this specific meeting. But the question is going to be, is there another rate hike come November? That feels like the market's
That's
kind of
more of a toss-up right now
on that expectation. Part of it also because of what we have seen from oil prices. There's concern about inflation re-accelerating on that front. That was reflected in the most recent CPI that we got. We've got Jen Schomburger at the Fed right now with the decision. Jen, what do you have?
No change. The Federal Reserve holding rates steady in the range of 5.25% to 5.5%, but leaving the door open for one more rate hike. Officials still see rates peaking in the range of 5.5% to 5.75%, implying one more rate hike from here. Now, 12 members are for one more rate hike, but 7 members actually wanted to keep rates at current levels. Now, when it comes to next year and rate cuts, officials now pricing in at the median 50 basis points of rate cuts from the expected peak of 5.5% to 5.75%. That's 50 basis points less than what was expected back in June, implying that officials see holding rates at higher levels for longer. Now, when it comes to future rate hikes, they said that will have to be contingent on the impact of previous rate hikes on the economy as well as economic developments. Now, the Fed retaining language in their statement buttressing this so-called dot plot that, quote, in determining the extent to which additional policy firming may be appropriate, the committee will take into account cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. Now, Fed officials noted in their statement that they still view inflation as, quote, elevated, and they remain highly attentive to inflation risks. Though they lowered their outlook for inflation, they now see inflation at 3.7% this year. That's down from 3.9% previously forecast. They see it dropping to 2.6% next year. The outlook for GDP was also revised higher to 2.1% from 1% previously, and next year's outlook was also revised higher to 1.5% from 1.1% previously. Now, officials also acknowledged in their statement that job growth has slowed, though they still characterize the job market as robust. They see unemployment now ending the year at 3.8% versus 4.1% previously. This decision was unanimous. Back to you.
And Jennifer, great stuff there. What do you expect to hear from Powell at the presser now?
Hey, Josh, great to see you. Great to have you on board. I really expect Fed Chair Powell to maintain a hawkish stance here. He does not want to send any signal that would loosen financial conditions, because that would mean that the Fed would have to go back in and actually do more work. They have things in the markets right where they want them right now. But at the same time, he wants to maintain that optionality, and that's why they are proposing one more rate hike. If they don't need to use it in November, then they don't need to use it, but they don't want to box themselves into a corner. They really want to avoid a 1970s scenario where inflation seemed like it was coming down under control, but then the Fed ended up having to go back in and really jack rates up higher, plunging the economy into a severe recession that we saw in the early 1980s. And that's really a scenario that Fed Chair Powell wants to avoid.
Okay, Jen Schomburger at the Federal Reserve for us. Of course, we're going to be waiting to hear from Fed Chair Jay Powell in about 30 minutes or so. I know you're going to be inside that press conference. Josh, let's do a quick check of where the markets are right now. We've seen it kind of take a leg down. The Dow still in positive territory, up about 104 points. The S&P 500 down about 4 there, and the Nasdaq down about 58. A number of things to run through here in terms of what that statement said, where things are. Jen highlighting 12 members see a rate hike, one more rate hike this year. 7 want to remain on hold. It's certainly going to be questions here about this divide that we continue to see on the FOMC about whether, in fact, it's necessary, given where inflation is right now, to go one more rate hike there. And then there's, of course, those who have been more dovish who've said, look, we need to wait for the lag factor to take shape. It would be too aggressive for another 25 basis point hike to take effect there. But it's going to be interesting to see how we hear the Fed chair sort of shape this. As Jen said, it has always, all this time, kind of been about optionality. You know, Jay Powell doesn't necessarily want to tip his hand because the market expectation would sort of move in the other direction, the expectation of rate cuts. He certainly wants to keep the options available right now, given where inflation is.
Yeah, and that makes sense. Listen, for him, I would expect to be a bit more cautious here because, again, core inflation, so excluding volatile food and energy categories, that is still above where the Fed wants it to be. And there's some interesting cross currents that, of course, they're navigating. That's why I'm very interested in this presser. We talk about oil, for example, moving higher. To what degree does that impact the economy, the consumer, inflation? We've got the UAW strike to contend with. And that, it's not just that sector, but we've seen those strikes across multiple sectors, airline pilots and UPS workers. In some cases, of course, they're able to negotiate higher pay, boosting wages. That's something the Fed's considering. And, of course, looming government shutdown as well. A lot of cross currents our central bankers are dealing with.
Certainly, on that last point, you know, we've seen the Fed not necessarily want to wade into politics, but the labor costs certainly going to be interesting. But oil really part of the big story when you think about the most recent CPI inflation print that came down from August. Oil contributing to big chunk of that,
100%.
Going up year on year. Let's bring in our panel for much more on the Fed decision today. We've got former Fed Special Advisor Andrew Levin. Also with us, we've got Abigail Watt, Aberdeen Research economist. Great to have both of you today. Abigail, let me just start with you and get your take on what we heard from the Fed so far.
Yeah, I think it's really interesting. I think we were expecting the kind of final hike to remain in the dots for this year. I perhaps think where we've maybe underestimated the changes was in that kind of, I guess, 50 basis point move up in the dot for 2025. I think that really kind of signals to 2024. I think that really signals to the markets this kind of higher for longer narrative. And I think this is the kind of line that the Fed is trying to walk between this kind of perhaps undue loosening in financial conditions too soon. And I think that's something that Powell's really going to have to try and walk the balance on in the presser later today.
Andrew, interested to get your take as well, just what you made of the Fed news here, what they did, what they said, and what do you see going forward?
Yeah, well, I agree with Abigail, actually. I think that the shift upward in the medium-term dot plot is actually really important. And I think the extent to which their statement today uses the word solid to describe economic activity is a good word. The fears that the people had 6 months ago that we were heading into recession, I think, have really faded. So one thing the Fed is reluctant to do is to talk about risks. And I think that the truth is there's an upside risk to the inflation outlook. Their outlook in the projections today is still very rosy. They expect that by the end of next year, inflation is going to be down around 2.5%, close to their target. But we can think of lots of scenarios where inflation's still running at 4 or 5%. And then a question, I guess I'm eager to hear from Abigail what she thinks about this. Is the Fed going to need to do more in that scenario where over the next 6 to 9 months, inflation's not sort of stabilizing near their target the way that they were hoping?
Andrew, let's talk specifically about those risks you highlighted. How much of a risk does oil pose right now? We know the Fed likes to look specifically at core inflation, strips out energy, and yet when you look at the recent inflation print, we're talking about gas prices jumping more than 10% in August alone.
Right. Well, I think there's a bunch of reasons why many measures of inflation are actually going to be higher over the next coming months. Another one, in addition to oil, is that workers are continuing to look for cost of living increases. We're seeing that nominal wage growth still running 2 to 3% higher than it was before the pandemic. In service industries, that's a big part of their cost. They have to pass it on into their prices. And that's part of what you're seeing with UAW, with the auto workers strike. Another factor is healthcare. The way the inflation measures are constructed, healthcare prices have looked really low, and inflation has looked really low over the past year. But that's going to be revised soon, and so we should be prepared that the healthcare component of inflation is going to be rising a lot and putting upward pressure on these inflation measures.
And Andrew brings up an interesting point there with the UAW. I'm interested in how you sort of think about that dynamic as well. You look at this organizing activity, unions on the move. Of course, it's not just the UAW. It's in airline pilots, UPS workers, Hollywood actors and writers. And sometimes these unions are going to the table, Abigail, as you know, and they're securing better pay packages themselves. They're boosting wages. How do you think about that dynamic for the economy moving forward?
I think it's a really interesting dynamic, and what you're really seeing is those areas where I guess bargaining power has been increased by labor shortages post-pandemic are those where you're seeing some of those kind of wage hikes coming through and those wage negotiations and strikes taking place. I think from our perspective, the key thing that we're thinking about is the ability to which this actually could lead to stickier wages. We have seen more progress on wages in recent months, and that's coming from the loosening that we've seen in the labour market thus far. But I think from the kind of Fed's perspective and the outlook for inflation in the US, I think that's the main concern that we're thinking about around some of this kind of increased labour bargaining within the US economy. I would say, though, that we have seen kind of an increase in kind of workers in those sectors where you did see the kind of biggest demand supply imbalances in the US labour market. And so the ability for some of these kind of negotiations to continue, I would likely say is kind of becoming less clear, especially as you've seen those adjustments in the labour market.
Abigail, even as we see these labor negotiations continue, we did see Walmart, the biggest employer, come out with that headline last week talking about bringing down some of the hourly wages for workers. That was sort of seen as potentially a harbinger of things to come, that maybe if the largest employer was looking at wages coming down, is that a sign that things are starting to get a little looser in the labor market? How should we view that dynamic?
Yeah, I mean, I think we've certainly seen kind of job openings coming off the boil. You've seen a big decrease in vacancies in the US economy. You've seen job growth itself kind of beginning to decelerate. And I do think that's something that, we're kind of looking for and hoping for in the case of bringing inflation back down to target for the US economy. I think the other thing that I would note is the extent to which that can kind of be sustained and continue from here.
And Andrew, so let me ask you this. So the Fed holds rates steady, but they indicate maybe one more hike. What would, Andrew, one more hike actually do? I mean, let's say they hike one more time. Would that have a meaningful impact?
No, it's really symbolic. I think that in the scenario I'm worried about, where inflation's turning upward instead of down, by allowing themselves, to still make another rate hike in December, which is probably when it would come if it does, is sort of a way to show that they're not asleep at the wheel. The fundamental problem is that what they're counting on is that actual inflation continues to head downward, and that makes monetary policy tighter as that happens, because if they hold rates at above 5 and inflation's running down at 2.5 or 3, that becomes a fairly tight monetary policy. Think about the interest rates relative to the inflation rate. The problem for them is if inflation continues to run in the range of 4 to 5%, then a rate of 5.5 or 5 3/4 is just not very tight, not going to create much downward pressure on inflation. That's the scenario where they may have to move significantly further.
Abigail, do you agree with that? That another 25 basis point hike, let's say in November, would be more symbolic, that the fundamentals right now of the economy don't necessarily dictate another rate hike?
I think my concern, actually, I think where I differ is around not around inflation stickiness and more around the strength and the resilience in the U.S. economy. I do think, obviously, there's been a clear increase in the probability of a soft landing. But one of the things that we're kind of cognizant of is the number of headwinds that are growing for the U.S. consumer. If we think about student loan repayments coming back in, if we think about the fact that excess savings have been depleted, and that's one of the things that has really helped support the U.S. economy so far this year. I think that's one of the kind of major risks that I see, actually, is that you see inflation pressures coming back down to target, but that's driven by a recession in the U.S. economy and not by kind of, the kind of more benign soft landing dynamics that I think markets are kind of pricing and hoping for currently.
And Andrew, I want to get you out of here on this. We've talked oil. Andrew, we've talked strikes, but another big headline that could be coming here, we're looking at a looming government shutdown. Is it possible, Andrew, if that happens, it slows the economy, is it possible the Fed is looking at as something that would almost help them in a way, that it would slow down the economy? Are they looking for that? Well,
it depends on what kind of shutdown. If it's over a weekend or a few days, it's a kind of drop in the bucket. If it's long and deep, that could definitely create further frictions. Like Abigail said, there's downside risk to the growth outlook. But Congress knows they're heading into election year, and so the extent to which they would allow a government shutdown to cause a recession, that would be really surprising for members of Congress to do that. So my expectation is that they'll figure out a way. And again, there might be a symbolic shutdown for 2 hours or 12 hours. That's happened before, but hopefully not something that derails what now is currently a pretty solid economy.
All right, Andrew Levin and Abigail Watt, thank you so much for that conversation. Very helpful. And now let's take a look at how markets are reacting after the Fed's latest policy decision. We've got Yahoo Finance's Jared Blickery and Yes Ferre with the latest market action. Jared.
Yes, well, we got a little bit of a downdraft in equities. Let's take the Nasdaq, for instance, which is now 0.5% down. You can see it started off the day in the green, was in the red right before the announcement, and then we got some negative price action right there. S&P 500 a little bit better off, but still in the red, and the Dow just giving up some of its gains here. By the way, the Russell 2000 still up as well. That's up about 15 basis points. Want to turn to the bond market, where we are seeing the 2-year Treasury note futures head down. Now, the futures are actually inverse to the price of yields. So if this is going down, we have yields going up and some other interesting things going on. I want to show what's happening with the euro, for instance. We have the euro selling off. That means the dollar is getting stronger as well. But yet, if we go into what the expectations are for November and take a look at this, before the report, we had a 70% chance that we were going to stay the course, stay at 5.25 to 550. This is in November. Now that is up to about 75%. So it looks like traders are just, and investors are just betting that the Fed is pretty much done here. So this got reduced to about 25%, and this was at 0. This is even closer to 0. So Ines, we've been talking about higher for longer for quite a long time here, and it's kind of showing up in the markets and kind of showing investors are just thinking maybe the Fed is done.
Yeah, that's right. Higher for longer, and perhaps why you're seeing also this initial reaction with the markets. Now, it's worth noting also that you do see a little bit of initial reaction, but a lot of times the markets don't react until Jay Powell starts speaking, right? Yes. Or even the day after as well. Sometimes you'll see fireworks there as well. But you're pulling up gold futures, and gold futures went down slightly. Also want to pull up right now gold futures year to date up more than 6.5%. It's up right now, right after that decision was made. And then just if we pull up WTI, we usually don't see reaction when it comes to crude. But something that we are expecting is to perhaps hear even questions to Jay Powell about oil, energy, and the impact that that's having on inflation, perhaps. And we have seen crude oil really going higher and higher over the last couple of months since late June, up about 30%. Goldman Sachs being the latest firm to come on board, saying that Brent will be reaching $100 a barrel. In fact, Goldman Sachs believes that Saudi Arabia could keep Brent prices between $85 and $105 a barrel throughout next year. So some expectations there of where oil's heading.
Yeah, WTI, as you were saying, oil doesn't usually react to these announcements per se, but it's a very important part of the discussion here. Also want to show what usually happens on Fed Day and the day after, since you did bring that up. I'm going to go to one of my slides here. So this goes all the way back to 2018 and shows the returns around Fed days. So here we have the overnight gap that tends to trend up. We see FOMC drift there. The Fed until 2 p.m., that tends to go up as well. But after 2 p.m., when we got Chair Powell taking the lectern there, things were not doing that well last year. This is 2022 and into 2023. They've kind of stabilized over the last Fed meeting. In other words, we did not have a disaster last time or the time before. And then we've actually seen slight increases net over the year in the day after Fed announcements. So I think as long as we're avoiding these huge surprises in here and nothing to indicate that we're going to get any kind of surprise today, I think things should be relatively okay there.
Yeah, that forward guidance, expectation of what the market is expecting, that'll be important.
Jared, I was going to say, always hard to forecast how the market's going to react to that press conference. And as I want to follow up on what you said, Goldman Sachs just the latest to call for that $100 a barrel. It sounds like they see these prices being a little more sustained going into next year. But what else are you hearing about whether, in fact, this is a temporary spike from those production cuts from the Saudis, OPEC Plus? How much of this is something that's going to be more sustained going into next year? Yeah, well, actually, Goldman believes that this Saudi Arabia, those unilateral cuts will start to be unwound next year around the second quarter, but you still have those OPEC Plus cuts. As far as some other firms are concerned, you do have, for example, Citi saying, yes, you may see oil going to $100 a barrel, but that should be for a short while. Then Citi is expecting it to pull back, and that's because of non-OPEC members that are putting more oil supply into the market. RBC Capital also saying that momentum is really going to send oil prices to $100 a barrel, but that's not their base case. They expect a pullback after that.
Jamie Dimon said 120 to 150 when it comes to oil, so we'll see.
Jamie Dimon, always with those explosive comments. Yes. Jared Blickery and Inez Frey, as always, great breakdown. Thanks so much for that. Yes. Well, markets are mixed following the Fed's latest decision to hold interest rates. But how will Jerome Powell's comments impact investors moving forward? And reminder, we've got that press conference kicking off in about 10 minutes or so. Let's bring in our next guest, Sonia Meskin, BNY Mellon Investment Management, head of U.S. Macro, as well as Michael Kushma, Morgan Stanley Investment Management, CIO of Broad Markets Fixed Income. Michael, I'm going to start with you. I mean, what stood out to you specifically on what we got from the FOMC statement? What are you going to be looking for in this press conference?
Well, I think what it reiterates is this idea of a very soft landing kind of economy, with the unemployment rate forecast being brought down, growth being upgraded significantly for this year and next year. All looks quite good. Why would you want to change interest rates if everything's going in the right direction of lower inflation, lower unemployment, and longer term? Rates are still targeted to drop as much as expected over the long term. That 2.5% terminal rate remains unchanged, so that we won't get as many rate cuts next year. We'll get maybe more than expected in 25, 26. So that's all a pretty benign, longer term view of things without too much stress. So if this forecast is accurate, you can see that without a meaningful recession, that risk assets, high yield bonds, emerging markets should do okay or well.
So, Sonia, Michael's saying maybe this forecast suggests a soft landing, so why mess with rates? Is that your take?
Well, I think the Fed, is never really, until we are clearly seeing a recession, is not in the business of saying we are going to go into a recession. Of course, they're going to, their central scenario is going to be to forecast a soft landing. It's their job to try their best to engineer that. I do think that this is a bit more of a hawkish message than maybe investors were hoping for. We do see this in the price action as well. Only 50 basis points of cuts next year. Certainly markets throughout this year were hoping for more cuts in 2024. They also solidified the view of another hike in 2023. And if you look at the dispersion around their forecast of the neutral rate, they're really moving towards forecasting a higher neutral rate down the road than they do currently. So I do think this is a bit of a hawkish message, and it reinforces the concern in the committee that they may have to do more to get inflation back down to 2%, as patient as they would like to be into 2026. There's still risks that unemployment is not just going to nicely stay around 4% and inflation come down on its own.
Michael, we saw a 10-year T-note yesterday tracking to the highest level we haven't seen since 2007. When you look at where the economic projections are coming from the Fed, what the expectation is potentially another rate hike come end of year, where do you see those yields tracking?
Well, it's an interesting question. I think the longer term, with inflation continuing to trend lower, 10-year bond yields 4% or up, if inflation does return to that low 2% level over time, 10-year bonds look pretty attractive. However, there's a high opportunity cost with 2-year notes still tracking higher on this idea of Fed funds staying higher for longer. It's very difficult for 10-year bond yields to rally if 2-year yields stay over 5%, and if they're staying over 5% for a longer period of time. I think that's really the message, that from their perspective, the economy is still quite robust despite signs of weakness in potential consumer spending and household spending in the future. So overall, it looks hard for 10-year bond yields to fall meaningfully as long as the economy is as strong as it is and the Fed believes it needs to keep rates this high, unless, of course, we end up with a much stronger slowdown and the Fed's forecast is incorrect about growth. The curve could get more inverted if the Fed has made a tactical error that rates don't need to be this high for this long. Then 10-year yields can rally. But the extent of the inversion of the yield curve suggests that it's very difficult for long-term yields to rally unless 2-year yields come down.
And just following up on that, so Michael pointing out the economy looking sturdy, but looking at it, what do you see the risk to that? Is it the labor market? Is oil? What are you watching? Sorry, that one's for Sonia.
Yeah, that's what I thought.
I think, what I would be concerned, the labor market does tend to be either a lagging indicator or a coincident indicator. It's not really a forward-looking indicator of the economy. So what I would pay more attention to is what's going on in the credit markets and where exactly are those high rates starting to bite, where I would go in to see refinancing walls come up in 2024 and potentially even 2025, since markets tend to be forward-looking. I think that the higher the business expense becomes for most companies and the more difficulty they have financing their operations in a high rate environment, and the more banks become constrained in lending, given the inverted yield curve, the more we can see kind of a slowdown really take hold. But the early signs of that, I think, would be more in the credit markets.
Sonia, what does that mean from an investment standpoint? I mean, this environment of higher for longer, do you sort of move away from the big cap names, maybe go for some of the smaller value plays, small caps? What are you thinking?
I do think individual stock picking and individual credit analysis would do quite well in this environment, because some corporates and some sectors would be better able to withstand these pressures than others. So there's an ample opportunity for stock picking in this environment, I would say, and along the credit lines as well. I would think too that, on the labor market front, you got to keep in mind that likely costs will remain elevated on the structural shortfall of labor supply versus demand in the U.S. And in addition to that, of course, higher energy prices.
And Michael, so Sonia's saying this is a stock picker's market along the credit lines as well. Does that make sense to you for people who are listening in, traders and investors?
I think it does. Interest rates are up substantially from where we were a couple of years ago, and there will be companies in the future which are going to run into difficulty in managing their businesses, especially if they're highly levered or dealing with much higher interest rates on their debt. So focusing on companies which have a strong business model, which can withstand the higher interest rates or adjust their business strategy to cope with higher interest rates, whether that requires injection of equity, paying down debt, deleveraging. I think focusing on those issues will be very important because we had 10 years almost of zero Fed funds rates or close to zero. And that changed corporate behavior and allowed some companies probably to survive and maybe do okay with zero interest rates. But as interest rates look like they're going to stay up in this 4 to 5.5% level for another year or two, that just changes the business outlook for I think many companies. So being careful about where you pick industries and companies will be very important.
Michael, really quickly, what does this mean from a fixed income standpoint in terms of investments? You're talking about T-notes. Where else do you look at in debt?
Well, I think that a focus on shorter maturities. You're getting paid a lot of extra yield to hold shorter maturity bonds. Cash out to 3-4 years, where you can buy 2-year corporate bonds, 3-year corporate bonds, over 6% yields. Those look pretty attractive medium term. While you can wait to see how the economy unfolds, how Fed policy unfolds, and then tactically move no longer. It seems unlikely that the Fed's going to have to raise rates meaningfully higher. Maybe one more rate hike, but it looks like the outlook looks pretty good for rates peaking these Fed funds rate this year. And that means that we can take advantage of high short-term yields while waiting for an opportunity to extend either credit risk and or maturity risk at some point in the fourth quarter.
Sonia Meskin, BNY Mellon Investment Management, head of U.S. Macro, as well as Morgan Stanley Investment Management, CIO of Broad Markets Fixed Income. Michael Kushma, good to talk to both of you. Really appreciate the time. We want to remind our viewers that we are awaiting that press conference from Fed Chair Jerome Powell, expected to take the podium anytime now over at the Federal Reserve. Some interesting comments coming through, Josh, in terms of what we have been hearing from guests as we watch the markets right now. We have seen all three majors kind of giving back some of the gains that we saw earlier in the day. Now it is about that additional rate hike that is now projected going into year end. Is that going to be November? But more importantly, looking into 2024, what are those rate cuts that will come, if in fact they do?
Yeah, it is interesting. I'm watching the markets as well as Kiko because they hold steady, as obviously we all anticipated. But as you noted, they do suggest that other rate hike. You look at the major averages, kind of flipping around here. We saw the S&P 500. Now we are back in the red, just barely, kind of hugging the flat line there. The Dow is up about 0.5%. The tech-heavy Nasdaq, that is down about 1/3%. As you noted, we saw the guests here saying, listen, if you're heading towards soft landing, if you believe that, meaning the inflation's coming down to 2%, that could make sense to hold steady.
Okay, let's head out to the Federal Reserve with the Fed Chair Jerome Powell.
Focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, we're in a position to proceed carefully in determining the extent of additional policy firming that may be appropriate. Our decisions will be based on our ongoing assessments of the incoming data and the evolving outlook and risks. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. And so far this year, growth in real GDP has come in above expectations. Recent readings on consumer spending have been particularly robust. Activity in the housing sector has picked up somewhat, though it remains well below levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our Summary of Economic Projections, or SEP, committee participants revised up their assessments of real GDP growth, with the median for this year now at 2.1%. Participants expect growth to cool, with the median projection falling to 1.5% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 150,000 jobs per month, a strong pace that is nevertheless well below that seen earlier in the year. The unemployment rate ticked up in August, but remains low at 3.8%. The labor force participation rate has moved up since late last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises from 3.8% at the end of this year to 4.1% over the next 2 years. Inflation remains well above our longer run goal of 2%. Based on the Consumer Price Index, or CPI, and other data, we estimate that total PCE prices rose 3.4% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 3.9%. Inflation has moderated somewhat since the middle of last year, and longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Nevertheless, the process of getting inflation sustainably down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.3% this year, falls to 2.5% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points. We see the current stance of monetary policy as restrictive, putting downward pressure on economic activity, hiring, and inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses. In light of how far we have come in tightening policy, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to our 2% goal over time. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 5.1% at the end of 2024, and 3.9% at the end of 2025. Compared with our June Summary of Economic Projections, the median projection is unrevised for the end of this year, but has moved up by 0.5 percentage point at the end of the next 2 years. These projections, of course, are not a committee's decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. Given how far we have come, we are in a position to proceed carefully as we assess the incoming data and the evolving outlook and risks. Real interest rates now are well above mainstream estimates of the neutral policy rate, but we are mindful of the inherent uncertainties in precisely gauging the stance of policy. We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you. Colby Smith with the Financial Times. What makes the committee inclined to think that the Fed funds rate at this level is not yet sufficiently restrictive, especially when officials are forecasting a slightly more benign inflation outlook for this year? There's noted uncertainty about policy lags. Headwinds have emerged from the looming government shutdown, the end of federal child care funding, resumption of student debt payments, things of that nature.
So I guess I would characterize the situation a little bit differently. So we decided to maintain the target range for the federal funds rate where it is at 5.25% to 5.5%, while continuing to reduce our securities holdings. And we say we're committed to achieving and sustaining a stance of monetary policy that's sufficiently restrictive to bring down inflation to 2% over time. We said that. But the fact that we decided to maintain the policy rate at this meeting doesn't mean that we've decided that we have or have not at this time reached that stance of monetary policy that we're seeking. If you looked at the SEP, as you obviously will have done, you will see that a majority of participants believe that it is more likely than not that it will be appropriate for us to raise rates one more time in the 2 remaining meetings this year. Others believe that we have already reached that. So it's something where we're not making a decision by deciding to about that question by deciding to just maintain the rate and await further data.
So right now it's still an open question about sufficiently restrictive. You're not saying today that we've reached this level.
We're not saying no. Clearly, what we decided to do is maintain the policy rate and await further data. We want to see convincing evidence, really, that we have reached the appropriate level, and we're seeing progress, and we welcome that. But we need to see more progress before we'll be willing to reach that conclusion.
And just on the 2024 projections, what's behind that shallower path for interest rate cuts and the need for real rates to be 50 basis points higher?
Right. So I would say it this way. First of all, real interest rates are positive now. They're meaningfully positive. And that's a good thing. We need policy to be restrictive so that we can get inflation down to target, okay? And we're going to need that to remain to be the case for some time. So I think, remember that of course, the SEP is not a plan that is negotiated or discussed really as a plan. It's accumulation, really, and what you see are the medians. It's accumulation of individual forecasts from 19 people, and then what you're seeing are the medians. So I wouldn't want to, bestow upon it the idea that it's really a plan. But what it reflects, though, is that economic activity has been stronger than we expected, stronger than I think everyone expected. And so what you're seeing is this is what people believe as of now will be appropriate to achieve what we're looking to achieve, which is progress toward our inflation goal, as you see in the SEP.
Thanks. Let's go to Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. How would you characterize the debate around another hike or holding steady? Is it discussion around lag times, fear of too much slowing, too little slowing? Could you walk us through what this disagreement was about at the meeting?
Yeah, so the proposal at the meeting was to maintain our current policy stance. And I think there was obviously unanimous support for that. But this, of course, is an SEP meeting, and so people write down what they think. And you have some, you saw, I think 7 wrote down no hike at this meeting, or between now and the end of the year, and I think 12 wrote down another single hike in one of the next 2 meetings that we have between the end of the year. So it wasn't like we were arguing over that. People just stating their positions. And really what people are saying is, let's see how the data come in. You know, we want to see, you know what we want to see. We want to see that these good inflation readings that we've been seeing for the last 3 months, we want to see that it's more than just 3 months, right? We want to see, you know, the labor market report that we received, the last one that we received, was a good example of what we do want to see. It was a combination of across a broad range of indicators, continuing rebalancing of the labor market. So those are the 2 things. Those are our 2 mandate variables, and that's the progress that we want to see. But I think people, they want to be convinced. You know, they want to be careful not to jump to a conclusion really one way or the other, but just be convinced that the data, you know, support that conclusion. And that's why, given how far we've come and how quickly we've come, we're actually in a position to be able to proceed carefully as we assess the incoming data and the evolving outlooks and risks and make these decisions meeting by meeting.
I see. And in your view, I know nothing has been decided yet, but what would one more hike at the end of the year do to the economy or to inflation? And on the other side, what would no hike do, if you could sort of game that out for us?
So, you know, you can make the argument that one hike one way or the other won't matter, but for us, we're trying, obviously as a group, it's a pretty tight cluster of where we think that policy stance might be, but we're always going to be learning from data. You know, we've learned all through the course of the last year that actually we needed to go further than we had thought. If you go back a year and what we wrote down, it's actually gotten higher and higher. So we don't really know and that's why, again, we're in a position to proceed carefully at this point. A year ago, we proceeded pretty quickly to get rates up. Now we're fairly close, we think, to where we need to get. It's just a question of reaching the right stance. I wouldn't attribute huge importance to one hike in macroeconomic terms. Nonetheless, you know, we need to get to a place where we're confident that we have a stance that will bring inflation down to 2% over time. That's what we need to get to, and we've been moving toward it. As we've gotten closer to it, we've slowed the pace at which we've moved. I think that was appropriate. And now that we're getting closer, we have the ability to proceed carefully.
Let's go to Steve.
Steve Leisman, CNBC. Mr. Chairman, I want to return to Colby's question here. What is it saying about the committee's view of the inflation dynamic in the economy that you achieve the same forecast inflation rate for next year but need another 0.5 point of the funds rate on it? Does it tell us that the committee believes inflation to be more persistent, requires more medicine effectively? And I guess a related question is, if you're going to project a funds rate above the longer run rate for 4 years in a row, at what point do we start to think, hey, maybe the longer rate or the neutral rate is actually higher? Thank you.
So I guess I would point more to, rather than pointing to a sense of inflation having become more persistent, I wouldn't think that's not, we've seen inflation be more persistent over the course of the past year, but I wouldn't say that's something that's appeared in the recent data. It's more about stronger economic activity, I would say. So if I had to attribute one thing, again, we're picking medians here and trying to attribute one explanation, but I think broadly, stronger economic activity means rates, we have to do more with rates, and that's what that meaning is telling you. In terms of what the neutral rate can be, you know, we know it by its works. We only know it by its works, really. We can't you know, the models and that we use, ultimately you only know when you get there, and by the way the economy reacts. And again, that's another reason why we're moving carefully now, because there are lags here. So it may of course be that the neutral rate has risen. You do see people. You don't see the median moving, but you do see people raising their estimates of the neutral rate, and it's certainly plausible that the neutral rate is higher than the longer run rate. Remember, what we write down in the SEP is the longer run rate. It is certainly possible that that the neutral rate at this moment is higher than that, and that's part of the explanation for why the economy has been more resilient than expected.
Let's go to Howard.
Howard Schneider with Reuters. Thank you. So you've said several times that the economy needed a period of below-trend growth to get inflation consistently back to 2%. You kind of get that in 2024, a little bit. 1.5% is just a touch below what's the estimate of potential. So the fact that you're getting so much done at so much less cost, does that represent a change in how you think inflation works, a change in how you think the economy works, a change in the mix of supply healing versus demand destruction that's necessary to achieve this?
Yes, of course, it is a good thing that we've seen now meaningful rebalancing in the labor market without an increase in unemployment, and that's because we're seeing that rebalancing in other places, in, for example, job openings, and in the jobs worker gap. You're also seeing supply side things, so that's happening. I would say, though, I still think, and I think broadly people still think that there'll have to be some softening in the labor market that can come through more supply, as we've seen as well. Also, remember, the natural rate we think is coming down, which is a supply side thing, so that the gap between any given unemployment rate that's lower than that and the natural rate comes down. That's a way for supply. That's a way for the labor market to achieve a better balance. So all of those things are happening. You're right. In the median forecast, we don't see a big increase in unemployment. We do see an increase, and but that really is just playing forward the trends that we've been seeing. That is not guaranteed. There may come a time when unemployment goes up more than that, but that's really what we've been seeing, is progress without higher unemployment for now.
So just to boil that down for a second, we've gone from a very narrow path to a soft landing to something different. Would you call the soft landing now a baseline expectation?
No, I would not do that. I would just say, what would I say about that? I've always thought that the soft landing was a plausible outcome, that there was a path, really, to a soft landing. I've thought that, and I've said that since we lifted off. It's also possible that the path is narrowed and it's widened, apparently. Ultimately, this may be decided by factors that are outside our control at the end of the day. But I do think it's possible, and I also think. This is why we're in a position to move carefully again, that we will restore price stability. We know that we have to do that, and we know the public depends on us doing that, and we know that we have to do it so that we can achieve the kind of labor market that we all want to achieve, which is an extended period, sustained period of strong labor market conditions that benefit all. We know that. The fact that we've come this far lets us really proceed carefully, as I keep saying. So I think, that's the end we're trying to achieve. I wouldn't want to handicap the likelihood of it, though. It's not up to me to do that.
Nick Timmeros of the Wall Street Journal. Chair Powell, both you and Vice Chair Williams have indicated that sufficiently restrictive will be judged on a real rather than nominal basis, implying some scope for nominal rate cuts next year, provided further compelling evidence that price pressures will continue to subside. Is the FOMC focused on targeting a real level of policy restriction? And can you explain what would constitute enough evidence that will allow the FOMC to normalize the nominal stance of policy while keeping real policy settings sufficiently restrictive?
I mean, yes, we understand that it's a real rate that will matter and that it needs to be sufficiently restrictive. Again, I would say you know sufficiently restrictive only when you see it. It's not something you can arrive at with confidence in a model or in various estimates, And so what are we seeing? We're seeing, through a combination of the unwinding of the pandemic-related demand and supply distortions and monetary policy's work in suppressing demand or alleviating very high demand, the combination of those two things is actually working. You're seeing, inflation coming down. It's principally now in goods, also in housing services. You begin to see effects of it in non-housing services as well. So we think that is working. And I think as we've said, we want to reach that. We want to reach something that we're confident it gets us to that level. And I think confidence comes from seeing, enough data that you feel like, yes, okay, this feels like we can for now decide that this is the right level and just agree to stay here. We're not permanently deciding not to go higher, but we would, let's say, if we get to that level. And then the question is, how long do you stay at that level? And that's a whole other set of questions. For now, the question is trying to find that level where we think we can stay there. And we haven't gotten to a point of confidence about that yet. That's the stage we're at, though.
But it looks like because there was an across-the-board drop in the core PCE inflation projection for this year, and even then it seems possible that core PCE inflation could come in even lower than the median at 3.7%. Would you see a case to raise rates still if it turned out that you were going to achieve the same real rate this year because the decline in inflation proceeds somewhat better than you currently anticipate?
The decision that we make at each meeting, and certainly at the last two meetings this year, it's going to depend on the totality of all the data. So the inflation data, the labor market data, the growth data, the balance of risks and the other events that are happening out there. We take all of that into account. So I can't really answer a hypothetical about one piece of that. It'll be trying to reach a judgment over whether we should move forward with another rate hike overall, and whether that would increase our confidence that yes, this is an appropriate move, and it will help us be more confident that we've gotten to the level that we need to get to.
Gina. Thanks, Chair Powell. Following up on Nick's question, actually, John Williams, the New York Fed president, obviously has said things to the effect of next year, as we see inflation, kind of again to Nick's point, as we see inflation coming down, we're going to need to reduce interest rates to make sure that we're not squeezing the economy harder and harder over time. And I wonder if that's basically the logic that you apply. Is that how you think about it? And then I also wonder, in the last press conference, you said something to the effect of, it's a full year out, those discussions, and people interpreted that to mean that you didn't see a possibility of a rate cut in the first half of next year. And I wonder if that was what you meant by that, or whether, how you're thinking about that timing.
No, when I answer these questions about hypotheticals about cutting, I'm never intending to send a signal about timing. I'm just answering them as the question is expressed. So please, I wouldn't want to be taken that way. Sorry, the first question was that how? Yeah, so we're, as we go into next year, that's the question we'll be asking is, taking into account lags and everything else we know about the economy and everything we know about monetary policy. The time will come at some point, and I'm not saying when, that it's appropriate to cut. Part of that may be that real rates are rising because inflation is coming down. Part of it just may be that it'll be all the factors that we see in the economy. And, that time will certainly come at some point. And what you see is us writing down, a year ahead estimates of what that might be. And, there's so much uncertainty around that. When in the moment, we'll do what we think makes sense. No one will look back at this and say, hey, we made a plan. It's not like that at all. These are estimates made a year in advance that are highly uncertain, and that's how it is.
Neil.
Thanks so much, Chair Powell. Neil Irwin with Axios. I wonder, how do you think about the question of whether the strong GDP growth that we've been seeing is driven by excess demand versus supply-side factors, productivity, labor force growth? And relatedly, if GDP keeps coming in hot, even in the absence of inflation resurgence, would that on its own be a reason to consider more tightening?
So on your first question, we're looking at GDP very, very carefully to try to understand really what's the direction of it, what's driving it, and it's a lot of consumer spending. The consumer's been very robust in spending. So that is, that's how we're looking at it. Sorry, your second question was?
There's GDP stays hot, but without inflation.
So I think the question will be, GDP is not a mandate, right? Maximum employment and price stability are the mandates. The question will be, is GDP, is the heat that we see in GDP, is it really a threat to our ability to get back to 2% inflation? That's going to be the question. It's not a question about GDP on its own. It's you're expecting to see this improvement, continued rebalancing in the labor market and inflation moving back down to 2% in a sustainable way. We have to have confidence in that, and we'd be looking at GDP just to the extent that it threatens one or both of those.
Victoria. Hi, Victoria Guida with Politico. There are multiple external factors that are playing out right now. We see rising oil prices. We see auto workers striking. There's the looming, very real possibility of a government shutdown. And I was just wondering, for each of those things, could you talk about how you're thinking about how that might affect the course for the Fed and the economy?
So there is a long list, and you hit some of them. But it's the strike, it's the government shutdown, resumption of student loan payments, higher long-term rates, oil price shock. There are a lot of things that you can look at. So what we try to do is assess all of them and handicap all of them. And ultimately, though, there's so much uncertainty around these things. To start with the strike, first of all, we absolutely don't comment on the strike, as we have no view on the strike one way or the other. But we do have to make an assessment of its economic effects to do our jobs. So, the thing about it is so uncertain. It will depend. The economic effects, it could affect, we've looked back at history, it could affect economic output, hiring, and inflation. But that's really going to depend on how broad it is and how long it's sustained for. And then it also depends on how quickly production can make up for lost production. So none of those things are known right now. It's very, very hard to know. So you just have to leave that uncertain, and we'll be learning, I think, over the course of the next intermeeting period. Much more about that. And the same is true for the others. I don't know if you mentioned shutdown. I think of all of these as being on the list. We don't comment on that. It hasn't traditionally had much of a macroeconomic effect. Energy prices being higher, that is a significant thing. Energy prices being up can affect spending. It can affect, over time, a sustained period of higher energy prices can affect consumer expectations about inflation. We tend to look through short-term volatility and look at core inflation, but so the question is, how long are higher prices sustained? We have to take those macroeconomic effects into account as well. Those are some of them. I'm not sure if I hit them all, but ultimately, you're coming into this with an economy that appears to have significant momentum, and that's what we start with. But we do have this collection of risks that you mentioned.
Craig Torres from Bloomberg News. I was a little surprised, Chair Powell, to hear you say that a soft landing is not a primary objective. This economy is seeing added supply in a way that could create long-term inflation stability. We have prime-age labor force participation moving up, where people can add skills. Workers want to work. We have a boom in manufacturing construction. We've had a decent spate of home building. And since inflation's coming down with strong GDP growth, we may have higher productivity. All are which good for the Fed's longer run target of low inflation. And if we lose that in a recession, aren't we opting for the awful hysteresis that we had in 2010? So are you taking this into account as you pursue policy? Thank you.
To begin, a soft landing is a primary objective, and I did not say otherwise.
Okay. All right.
I mean, that's what we've been trying to achieve for all this time. The real point, though, is the worst thing we can do is to fail to restore price stability, because the record is clear on that. If you don't restore price stability, inflation comes back, and you can have a long period where the economy is just very uncertain, and it'll affect growth. It'll affect all kinds of things. It can be a miserable period to have inflation constantly coming back and the Fed coming in and having to tighten again and again. So the best thing we can do for everyone, we believe, is to restore price stability. I think now, today, we actually, we have the ability to be careful at this point and move carefully, and that's what we're planning to do. So we fully appreciate the benefits of being able to continue what we see already, which is rebalancing in the labor market and inflation coming down without seeing, an important, large increase in unemployment, which has been typical of other tightening cycles. So.
Let's go to Chris.
Hi, thank you. Chris Rugaber at Associated Press. When you look at the disinflation that has taken place so far, do you see it mostly as a result of what some economists are calling the low-hanging fruit, such as the unwinding of supply chain snarls and other pandemic disruptions, or is it more a broad disinflationary trend that involves most goods and services across the economy? Thank you.
So if I understood your question, I would say it this way. I think we knew from before when we lifted off, but certainly by the time we knew that bringing inflation back down was going to take, as I call it, the unwinding of these distortions to both supply and demand that happened because of the pandemic and the response. So that unwinding was going to be important. In addition, monetary policy was going to help. It was going to help supply side heal by cooling demand off, and just in general, better aligning supply with demand. So those two forces were always going to be important. I think it's very hard to pull them apart. They work together. I do think both of them are at work now, and I think they're at work in a way that shows you the progress that we are seeing.
Go to Mike.
Michael McKee from Bloomberg Television and Radio. In June, you forecast a 5.6% year-end median Fed funds rate, and since then, you've more than doubled your growth forecast. You lowered your unemployment forecast significantly. So what would justify that last move? Because the median forecast is for lower inflation. And given all the known unknowns that you face, how much confidence do you have, can investors have, or the American people have in your forecasts?
Well, forecasts are highly uncertain. Forecasting is very difficult. Forecasters are a humble lot with much to be humble about. But to get to your question, though, what's happened is growth has come in stronger, right? Stronger than expected, and that's required higher rates. Unemployment, you also see that the ultimate unemployment rate is not as high, but that's really because of what we've been seeing in the labor market. We've seen more and more progress in the labor market without seeing significantly higher unemployment. So we're continuing that trend. In terms of inflation, you are seeing the last three readings are very, very good readings. It's only three readings. We were well aware that we need to see more than three readings. But if you look at June, July, and August, you're looking at really significant declines in core inflation, largely in the goods sector, also to some extent in housing services, and just a little in non-housing services. Those are the three buckets. Headline inflation, of course, has come way down, largely due to lower energy prices, some of which is now reversing. So I think people should know that economic forecasting is very difficult, and these are highly uncertain forecasts. But these are our forecasts. We have very high quality people working on these forecasts, and I think they stand up well against other forecasters. But just the nature of the business is the economy is very difficult to forecast.
Given the forecast that you have, what justified not moving today, and what could justify moving in the future if you think inflation is coming down? In other words, why did you leave that extra dot in?
Well, I think we have come very far, very fast in the rate increases that we've made. And I think it was important at the beginning that we moved quickly, and we did. And I think as we get closer to the rate that we think, the stance of monetary policy that we think is appropriate to bring inflation down to 2% over time, the risks become more two-sided. And the risk of over-tightening and the risk of under-tightening becomes more equal. And I think the natural common sense thing to do is as you approach that, you move a little more slowly as you get closer to it. And that's what we're doing. So we're taking advantage of the fact that we have moved quickly to move a little more carefully now as we sort of find our way to the right level of restriction that we need to get inflation back down to 2%.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. With your focus on year-over-year PCE, isn't it true that base effects are huge and that by the time you meet in November, that it's more likely that you'll have a low PCE number that would make you feel more comfortable? And secondly, how would the lack of key indicators like CPI, the jobs report, impact your approach in upcoming meetings if we were to have a government shutdown? Thank you.
Yeah, I missed the first question. What was the what factors?
The base factors.
Base factors. Okay. So on that, we're looking at just monthly, right? You can look at just monthly readings and see what the increase was from the prior month. So you're right. When you go back 3, 6, and 12 months, you get base factors, but we can adjust for that. In terms of not getting data, again, we don't comment on government shutdowns. It's possible if there is a government shutdown and it lasts through the next meeting, then it's possible we wouldn't be getting some of the data that we would ordinarily get, and we would just have to deal with that. And I don't know. It's hard for me to say in advance how that would affect that meeting. It would depend on all kinds of factors that I don't know about now, but it's certainly a reality that's a possibility.
But would you feel more comfortable on the base effects that as those kind of fall out of the equation for the next couple of readings by November, would you feel more comfortable at that point?
Yes. I mean, if you're looking, if we can tell how much inflation has gone up in a given month, right? And that's what we're looking at. And month by month, what's the reading? And I think what we're really looking at is there's a tendency to look at shorter and shorter maturities, but they're incredibly volatile and they can be misleading. That's why we look at 12-month. But I think in this situation where it looks like we've had a bit of a turn in inflation starting in June, we're also looking at 6 months and even 3 months, but really 6 months inflation. So you're looking at it over that period and over longer periods. That's the right way to go. And we don't need to be in a hurry in getting to a conclusion about what to do. We can let the data evolve.
Thanks for the question, Chair Powell. Edward Lawrence with Fox Business. So I want to focus back in on oil prices. We're seeing oil prices, as you mentioned, move up, and that's pushing the price of gas. So how does that factor into your decision to raise rates or not? Because the last two inflation reports, PCE and CPI, we've seen the overall inflation has actually risen.
Right. So, energy prices are very important for the consumer. This can affect consumer spending. It certainly can affect consumer sentiment. I mean, gas prices are one of the big things that affects consumer sentiment. It really comes down to how persistent, how sustained these energy prices are. The reason why we look at core inflation, which excludes food and energy, is that energy goes up and down like that, and it doesn't. Energy prices mostly don't contain much of a signal about how tight the economy is, and hence don't tell you much about where inflation's really going. However, we're well aware, though, that if energy prices increase and stay high, that'll have an effect on spending, and it may have an effect on consumer expectations of inflation, things like that. That's just things we have to monitor. So.
On the consumer, they're putting more and more of this on their credit card. The consumer seeing record credit spending. How long do you think the consumer can manage that debt at higher interest rates now? And are you concerned about a debt bubble related to that?
So to finish my prior thought, I was saying that's why we tend to look through energy moves that we can see as short-term volatility. Turning to consumer credit, of course we watch that carefully. Consumer distress, measures of distress among consumers were at historic lows quite recently, during and after the pandemic. They're now moving back up to normal. We're watching that carefully, but at this point, these readings they're not at troublingly high levels. They're just kind of moving back up to what was typical in the pre-pandemic era.
Jean.
Hi, Jean Young with M&I Market News. Yields along the Treasury curve have risen to their highest in years. What is the Fed's view about what's been driving that increase in recent weeks? And how much of it can be attributed to macro explanations and how much to technical factors?
So you're right. Rates have moved up significantly. I think it's always hard to say precisely, but most people do a common decomposition of the increase, and the view will be it's not mostly about inflation expectations. It's mostly about other things. Either term premium or real yields, and it's hard to be precise about this. Of course, everyone's got models that'll give you a very precise answer, but they give you different answers. So, but essentially, they're moving up because it's not because of inflation. It's because it'll probably have something to do with stronger growth. I would say more supply of treasuries. The common explanations that you hear in the markets kind of make sense.
Kyle Campbell, American Banker. Thank you for taking the questions. Just two on housing. You've said slower shelter cost growth is in the pipeline and will reflect in inflation readings as new leases are signed. But there's also some questions out there about the way housing costs are measured, particularly the use of rental equivalents, which are estimates from homeowners about what their homes would rent for if they were in the rental market. So my question is, how much of the effort to tame inflation, both as it's measured and felt by the broader public, hinges on housing supply? And then as far as a constrained housing supply being sort of exacerbated by this sort of lock-in effect of mortgages being higher now than they were at their recent historic lows, how is that going to impact future thinking about taking interest rates to that lower bound in the future?
So on the supply point, of course, supply is very important over time in setting house prices and for that matter rents, and supply is kind of structurally constrained. But in terms of where inflation's going in the near term, though, as you obviously know, a lot of it is leases that are running off and then being re-signed or released at a level that's it won't be that much higher. A year ago it would have been much higher than it was a year before. Now it may be below or at the same level. So as those leases are rolling over, we're seeing what we expect, which is measured housing services inflation coming down. Your second question was the lock-ins. How much is that affecting things, really?
Is that going to affect your decisions to potentially bring rates down to their lower bound in the future, sort of creating that sort of bubble of buying and then a lock-in that sort of stagnates the housing market?
I think I would look at the lock-in, the idea being that people are in very low rate mortgages, and even if they want to move now, it would be hard because the new mortgage would be so expensive. And that's explaining that's one of the explanations for what's happening broadly in the labor market. Would that play a role in our future decisions in a future loosening cycle about whether we would cut rates? No, I don't think it would. I mean, I don't think that's. I think we'd be looking at what fundamentally what rates does the economy need, and in an emergency like the pandemic or during the global financial crisis, you have to cut rates to the point that you have to do what you can to support the economy. So I wouldn't think that would be a reason for us not to do that. It's not something we're thinking about at all right now, but down the road I wouldn't think so.
Nancy. Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, you've mentioned several things that would possibly weigh on consumer confidence, maybe cut back consumer spending, possible government shutdown, high gas prices. At this point, would the Fed welcome a decrease in consumer spending? Would that help you get inflation closer to your 2% target?
I wouldn't say it that way. We're not looking for a decrease in consumer spending. It's a good thing that the economy is strong. It's a good thing that the economy has been able to hold up under the tightening that we've done. It's a good thing that the labor market's strong. The only concern, and it just means this: if the economy comes in stronger than expected, that just means we'll have to do more in terms of monetary policy to get back to 2%, because we will get back to 2%. Does that answer your question?
Yeah, and I guess on the other hand, would you worry that that could contribute to an economic slowdown or even a recession?
Well, that's always a concern. I mean, concern number one is restoring price stability, because in the long run, that's something we have to do so that we can have the kind of economy we really want, which is one with sustained period of tight labor market conditions that benefit all, as I've said a couple times. So that said, of course, we also now, given how far we've come with our rate hikes and how quickly we've come here, we do have the ability to be careful as we move forward because of that consideration.
Simon.
Thank you, Chair Powell. Simon Rabinovich with The Economist. One of the factors in the economic resilience to date appears to be a lesser degree of rate sensitivity than in the past. Obviously, we've talked about households with long fixed-rate mortgages, also companies that refinanced before last year. What is your thinking about the efficacy of rates and how that's changed? And then related to that, how do you think about the distributional consequences in the sense that if you're a relatively wealthy household with a long fixed-rate mortgage, the past year has not been all that tough with rates going up, whereas if you're relying on your credit card for supporting your consumption, in fact, times are getting a lot tougher, a lot more quickly. Thanks.
So I guess it's fair to say that the economy's been stronger than many expected, given what's been happening with interest rates. Why is that? Many candidate explanations. Possibly a number of them make sense. One is just that household balance sheets and business balance sheets have been stronger than we had understood, and so that's spending is held up and that kind of thing. We're not sure about that. The savings rate for consumers has come down a lot. The question is whether that's sustainable. It could just mean that the date of effect is later. It could also be that for other reasons, the neutral rate of interest is higher for various reasons. We don't know that. It could also just be that policy hasn't been restrictive enough for long enough. And there are many candidate explanations. We have to, in all this uncertainty, make policy. And I feel like what we have right now is what's still a very strong labor market, but that's coming back into balance. We were making progress on inflation. Growth is strong, but I think by many forecasts, many forecasts call for growth to moderate over the course of the next year. So that's where we are, and we have to deal with what comes. On your second question, your second question was distributional, but can you be a little clearer about that?
Yeah, my point there was that if you're somebody who has a long fixed-rate mortgage, you've been able to endure the higher rates relatively easily. If you're somebody who's living month to month off of your credit card, current financing rates are punitive.
Yes, and so the point I would make there is that we're trying to get inflation back down. The people who are most hurt by inflation are the people who are on a fixed income. If you're a person who spends all of your income, you don't really have any meaningful savings. You spend all your income on the basics of life: clothing, food, transportation, heating, the basics. And prices go up by 5, 6, 7%. You're in trouble right away. Whereas even middle class people have some savings and some ability to absorb that. So it is for those people, as much as for anybody, that we need to restore price stability. And we want to do it as quickly as possible. Obviously, we would like to do that. We'd like the current trend to continue, which is that we're making progress without seeing the kind of increase in unemployment that we've seen in past things. But you're right, though. When we raise rates, people who are living on credit cards and borrowing are going to feel that more. They are. And of course, people with lots of savings also have a much lower marginal propensity to consume, and so it's not going to affect them as much.
Let's go to Greg Robb for the last question.
Thank you, Chair Powell. Greg Robb from MarketWatch. In the Beige Book recently, you can tell that the Fed has been surveying nonprofits and community groups about the economic health of low-income Americans, moderate-growth Americans. I have two questions about this. Are you going to use that data to maybe come up with sort of like a quarterly survey of those groups, like the senior loan officer survey? And and also the second question is, from your recent readings of these surveys, how are low and moderate Americans doing? Is there this thing where like the GDP is strong because of wealthy Americans kind of driving things? And just want to get your sense of the health of that sector. Thank you.
So I don't know about the quarterly survey. That's an idea we can take away and think about. In terms of how low and moderate Americans, they're clearly were suffering from high inflation. I think during the pandemic, the government transfers that happened were very meaningful. And if you know the surveys that we take showed that low and moderate income people were actually in very, very strong financial condition. I think now it's a very hot labor market, and you're seeing high nominal wages. And you're starting to see real wages are now positive by most measures. So I think overall households are in good shape. Surveys are a different thing. So surveys are showing dissatisfaction, and I think a lot of that is just people hate inflation, hate it, and that causes people to say the economy is terrible. But at the same time, they're spending money. Their behavior is not exactly what you would expect from the surveys. That's kind of a guess at what the answer might be, but I think there's a lot of good things happening on household balance sheets, and certainly in the labor market and with wages. The biggest wage increases having gone to relatively low wage jobs, and now inflation coming down, you're seeing real wages, which is a good thing. Thanks very much.
You have been listening to Fed Chair Jerome Powell with that live press conference coming out of the Federal Reserve. Josh Lipton and I here at the New York Stock Exchange tracking all that for you, along with the market reaction. We saw the Nasdaq hitting a session low in the middle of all of that, but the Dow up 58 points, the S&P 500 down 21, and the Nasdaq down 122. The FOMC, to reiterate today, coming out with their latest decision. No change in their interest rates, but they did have an update on the summary of economic projections. 12 members seeing a rate hike, one more rate hike this year, 7 maintaining a hold, at least for this year. We also saw the Fed now forecasting just 2 rate cuts going into 2024 instead of 4. And then the Fed funds rate now projected to fall from 5.6% in 2023 to 5.1% in 2024. 3.9 is what we're looking at in 2025. A number of things to go through here, Josh, as we heard the Fed chair speak for quite a long time here, about 45 minutes or so. In terms of where things stand, he was really pressed on, where is this policy? Are you in a place that is sufficient right now? Is it sufficiently restrictive? I think that was the question that was asked multiple times. He said maintaining the policy is where we are. It doesn't necessarily mean that we're not going to move, but we have to see more progress. Just 3 months of data is not going to do it. That's sort of reiterating what we have heard from the Fed chair before. But one line that really stood out to me in all of this, as the market tries to assess where the Fed is going moving forward, he said, ultimately, you only know when you get there. Not necessarily a reassuring message coming from the Fed, but I think it does point to just the uncertainty this committee is seeing in the economy right now with the lag factor coming out of the pandemic. And then, of course, all these other risks that he talked about, including the UAW strike, that is not necessarily in the control of the Federal Reserve.
Listen, the Fed is dealing with a lot of cross currents right now, powerful. As you noted, we have the UAW, you've got oil, you've got a looming government shutdown coming up. What struck me is a few things. One is repeats a phrase we know he likes, proceed carefully. I heard him say that at Kiko, I think at least 3 times, which makes sense because they continue to have to navigate this really tough needle, keep tamping down inflation, but don't tip the economy into a downturn. On your point on the inflation, also I thought some of the language there very interesting. The process of bringing inflation down to 2% has a long way to go, he said. So they made progress. He says they welcome that, but he feels like they have more work to do. We know core inflation, excluding volatile food and energy categories, that is still above where Jay Powell wants to see it. Remember, there was some back and forth. Remember, there were some economists, some notable economists who were saying, well, maybe it shouldn't be 2%. Maybe it should be 3%. It shouldn't be set in stone, but not according to Jay Powell. I think the bottom line is higher for longer.
And one more thing to add here, because you talk about some of the cross currents that are happening. as the Fed sees sort of core inflation sort of hold where it is, not necessarily at the 2% mark, but not necessarily accelerate. He did talk about the concerns around energy, and we've sort of highlighted that oil prices going up, at least in the latest inflation print in August, more than 10%. And he said, look, energy prices being higher is a significant thing, but it is about the sustained level of those prices. Right now, you know, not just the Fed, but also economists trying to figure out, is this just a short-term spike that we're seeing coming from the production cuts stemming from the Saudis and OPEC Plus? Is this going to be more sustained? So something to be considering as we look ahead to where the Fed policy is going to move moving forward. Let's do a quick check of the markets brought to you by Tasty Trade, and bringing in Jared Blickery, who's tracking all this very closely. Jared, we saw the markets move a leg lower. The Nasdaq now down about 114 points. I know you're watching Treasury yields there as well. What stood out to you?
Yeah, first of all, not huge movements overall. I'm going to show you some charts here. Here's the Dow coming into the 2 p.m. announcement. We were higher on the day, then we sank into it. Powell took the lectern, and then we saw a little bit of a bump up, but we sold off from those prior levels from before, and then we hit a new low of the day. But you can see we're still in green territory. Even at the highs of the day, we were not that, had not moved that much. Here is the Nasdaq. You can see it's down not even 1%, but we did take a leg lower, similar to some of the other sectors. Here's the S&P 500, pretty similar chart right there. Akiko, you're watching the bond market, so am I, like a hawk. And here we saw a jump up in rates. This is kind of the opposite movement of what we saw stocks do. Then we saw a decrease and then a reacceleration to the upside, but not really back up to unchanged. So really not seeing too much of a movement here. And then just in terms of prospects for November, coming into the meeting, here's what we were looking at. And let's see if we can get that up here. We were looking at about a 70% chance of there we go, 70% chance of everything staying the same. In other words, no rate hike, no rate cut in November, 30% chance of a cut. But now that's up to about 75%, came down a little bit. I think traders are a little bit spooked by what he said. It's not that the Fed is going to get more hawkish. It's that the economy is a little bit not quite as resilient as traders might have thought otherwise. I thought the comments about the base effects was also particularly enlightening. And Jennifer Schomburger here is going to tell us about what she observed in that room with Jay Powell.
All right, Jared Blickery with a breakdown of the market moves so far. Thanks so much.
And as expected, the Federal Reserve holds rates steady, however, leaving the door open to one more hike as the committee remains committed to returning inflation to its 2% target. Here with more on what Fed Chair Powell had to say on the latest FOMC decision, we have Yahoo Finance's Jennifer Schomburger. Jennifer.
Hi, Josh. Yeah, Fed Chair Powell very much keeping his options open during this press conference, saying that even though the committee decided to maintain rates at current levels, that doesn't signal whether they have reached their destination. He says it doesn't mean the Fed has decided whether or not they have reached the stance of monetary policy they are seeking. Quote, Powell saying that the Fed really still needs to see convincing evidence that they've reached the appropriate level, and the Fed needs to see more progress before coming to that conclusion. I asked the Fed chair whether when we see base effects really fall out of that core PCE number by the November meeting, if it would be low enough to make him feel more comfortable and more confident. Take a listen.
We can tell how much inflation has gone up in a given month, right? And, you know, that's what we're looking at. And month by month, what's the reading? And, you know, I think what we're really looking at is there's a tendency to look at, you know, shorter and shorter maturities, but they're incredibly volatile and they can be misleading. That's why we look at 12-month. But I think in this situation where it looks like we've had a bit of a turn in inflation starting in June, we're also looking at 6 months and even 3 months, but really 6 months inflation. So you're looking at it over that period and over longer periods. That's the right way to go.
I also asked Fed Chair Powell what the Fed would do if they didn't get the inflation data, the jobs report data that they need for the next FOMC meeting if there were to be a government shutdown. He told me, quote, that they would just have to, quote, deal with that, and that it was hard for him to say in advance how that would really affect that meeting. Now, Powell did reiterate what he said in Jackson Hole, that the Fed is prepared to do further rate hikes if appropriate, and that they do intend to hold rates at higher levels until inflation comes convincingly back towards the Fed's 2% target. And certainly we saw that in the Fed rate projections put out this afternoon. Now, Powell also said that real rates are in meaningfully positive territory, and the Fed would really need to keep them there to see inflation meaningfully come back down. Guys.
And Jennifer Schonberger there for us. Jennifer, thanks so much. Great stuff. And policymakers' expectations of where interest rates could be headed in the future suggest the Fed will likely raise rates one more time this year. And here to discuss the future path for Fed policy, we have former president of the Federal Reserve Bank of Atlanta, Dennis Lockhart. So, Dennis, let me start with this. Just your response and your reaction, Dennis, to what the Fed did and said today.
What the Fed did in this meeting, I don't think it was a big surprise. I thought actually almost everything came in according to expectations. There was an expectations of them signaling one more rate hike, which they did in a very conditional way. I think it was expected that the higher for longer message would play through to a higher funds rate at the end of next year, and that came through. I did not perceive a lot of new information, really, and I think Chair Powell was trying to be extremely even-handed and balanced in his comments in his press conference.
You know, what do you make, Dennis, about the Fed trying to maintain this optionality? I mean, he was asked multiple times in this press conference about whether the policy currently was sufficiently restrictive enough. You know, he seemed to suggest that, look, 3 months, the latest inflation prints certainly pointed to a good sign. But I wonder, as you hear the language coming out of the FOMC, what are they looking for in order to determine that additional rate hike?
Well, first, let me comment that I think he emphasized uncertainty. Proceed carefully. You've already said that. He's keeping his options open because they really don't know how the data are going to evolve. We are at a point right now where we've seen some higher energy prices. Now they're factored out in the core calculation. But remember, energy prices are in everything that we consume, practically everything, goods and services. So there are second order effects of energy prices that are yet to play through in prices. So we're at a very uncertain moment from their perspective. And what are they looking for? They're looking for a continuation of the trend that we've seen in the last 3 reports of disinflation and convincing evidence that they're on a path to the 2%. I think what they would say right now is we've seen good reports, but we're not yet convinced.
And Dennis, just to emphasize those higher energy prices, because Jay Powell did discuss that, does that stoke inflation, Dennis, or does that actually dampen growth? Meaning, we're going to our gas stations, we're topping off the tanks, you see that bill, and you think the best bet is to cut back on spending. Which is it, Dennis?
It's both, actually. It dampens growth in the sense that the consumer is affected by gasoline prices. One of the things I learned when I was at the Fed is it's probably the most prominent price that the consumer experiences. And therefore, what happens at the gas pump factors through to spending on the part of households. So that's certainly an effect, and that would perhaps dampen activity. At the same time, energy is involved in all transportation of goods. It's involved in transportation services that we all consume, airlines and such. And some of those influences are delayed. It takes time for the higher prices to actually be reflected in prices. So we could see inflationary pressures that are in the core measure of goods that reflect some pressure from energy prices.
Dennis, on that point, though, we did hear the Fed chair say, look, it depends on how long these prices stay at this level, how sustained they are. We're talking about those like Goldman calling for $100 a barrel for a little longer going into next year. I mean, how do you calculate that impact on inflation so far? You mentioned the lag factor, and that's certainly going to be something we're going to be looking for. But given how quickly it has gone up.
Well, sometimes we forget, or sometimes we have a tendency to conflate higher prices that have moved higher and then stabilized with inflation. Inflation is a rate of change. So I think the question is, how long will it take for the most recent rise, assuming we don't see any further rise in energy costs, to play through to prices, and then when will that stabilize? And that could be a matter of some months. You know, for example, there are energy costs in crops, and the crops have to complete their growing cycle and then be harvested. But there may be, you know, in some respects, farmers are looking for higher income from their harvest, and that could be sometime next year. So it's really hard for me to give you a number, but the point is that energy is pervasive, but we're looking at the rate of change of energy prices.
Well, Dennis, thank you so much for your time today, sir. That was really helpful, and we appreciate it. That was former president of the Federal Reserve Bank of Atlanta, Dennis Lockhart. And switching gears, Klaviyo shares are surging in their trading debut, up over 20% right now. Notably, Klaviyo is the first U.S. venture-backed software company listing since late 2021. And of course, they consider themselves a big play in the AI space. Our Shauna Smith had the chance to speak to the CEO, Andrew Bialecki, about the AI hype. Take a listen to what he had to say.
Machine learning, artificial intelligence has been core to our strategy, I mean, really for the last 5, 6, 7 years. I think if you look at a lot of, we'll just take marketing as a space, you know, you have to be a really talented marketer, and you're still experimenting to figure things out. Every customer I talk to says, Andrew, what ideas do you have that I may be not thinking about? Well, the good news is you can use artificial intelligence to not only generate content, but help come up with those ideas. I think in the future, you know, we're going to build software that is good at using itself. So in this case, the marketing software, literally, you plug your business into Klaviyo, it'll develop your marketing strategy, and if you're whatever your growth goals are, it'll build that optimal path to help you get there.
So should investors be thinking of Klaviyo almost as an AI play?
Yes, I mean, we think about it as we've built the data infrastructure to store all your data, the applications, the marketing software to connect with those customers, and then it's really artificial intelligence that brings it all together so that even if you're not a great marketer or you want more advice, you can get that automatically with our software.
So Klaviyo, marketing automation platform, software company, and a software company, Kiko, that's still growing strongly, right? I mean, so they are producing a profit, and during the first 6 months of the year, you're talking about a company that saw its top line grow more than 50%.
Yeah, you know, it's been interesting to me to watch the price action here, because this week we saw, obviously, Instacart debuting yesterday. Yeah. We're talking about Klaviyo today. And it is sort of a good test of, number one, where the investor appetite is, but whether, in fact, these companies are ready to come to market. Yesterday, we were talking about Instacart commanding a much higher valuation in the private side of things. Klaviyo, you could argue, really priced just right. I mean, yes, they have seen a big pop, but it is sort of in line with where they priced at. And then when you look at the market cap, yes, just day one, but we're looking at more than $8 billion. In the private side of things, the last funding round, they were above $9 billion. So you're not seeing as much of that differential. Now, the question to me is going to be, now that we've had these two big debuts, what are we going to hear from these other big startups that are waiting on the sidelines? Yep. Is this an incentive for them to get in? You could argue that there's a bit of a split picture. Some would say, well, their finances still aren't in order. It doesn't necessarily mean a rush to the markets.
Yeah, it is. You've had this sort of wave, we'll call it a mini wave, a very, very small wave of companies making their public debut. And some of the characteristics here are interesting because the companies are coming public. They want to produce a profit and show strong growth. And you wonder, in a time right now when there are alternatives for investors, listen, you can look to T-bills, you can look to muni bonds. Maybe that's kind of the profile of the company, that if they want to take a public plunge, that's what you got to show.
Yeah, higher rates certainly going to weigh on higher debt where their companies are. We've heard for long that investors are looking more for this profitability, where that path is. You could argue at least Instacart and Klaviyo, the first 2 days that we've seen here, they have passed the test, at least in terms of the public markets.
Yep, we'll see. Well, coming up, shares of Coty are getting a lift this morning. Consumers spending money on perfume and beauty products. We'll bring you the details after the break. Shares of online pet food supplier Chewy having a rough day following a downgrade. Yahoo Finance's Brooke DePalma here with more on the move.
Good afternoon, Josh. That's right. Tough day for Chewy shares, sliding as we approach sessions close today, down more than 5% now, following a downgrade from Oppenheimer from outperform to perform. Analysts, they are expecting a more challenging backdrop to persist for at least a few more quarters. The analysts also noted recent signs of weakness in what is historically a resilient pet food category. But we know that consumers in this environment are looking for value. Back in January, Chewy cited that they're seeing a bit of a shift in consumer behavior from buying wet food to dry food. They also noted that consumers are buying less treats. And we also know that the company has been able to pass along some price increases to consumers as inflation remains sticky, but that might not be the case in the coming year. Yahoo Finance's Shauna Smith asked Chewy CEO Smit Singh about those pricing pressures and what he's seeing in the industry. Take a listen.
Pre-pandemic, pet inflation used to be somewhere in the low to mid single digits. And currently, pet inflation is in the low double-digit range. And so it has started to normalize. It used to be even higher 3 months ago. But we believe it's going to take a few more quarters for it to completely normalize.
And also weighing on shares today is retail giant Walmart announced that they're entering by opening a pet services center down in Georgia. They're going to offer vet care, grooming, as well as a self-serve dog wash. Year to date, shares of Chewy down nearly 50%. And today, shares are on course to decline for the 9th session out of 10 recent trading sessions.
Okay, some steep losses there. Brooke DePalma, thanks so much for that. Well, another ticker. Okay, let's move on here to the market. Still digesting the Fed's decision to leave rates unchanged. Major indices now all in the red, with the Nasdaq seeing the steepest losses, down about 1.3%. The question, of course, is where do we go from here? Where are the bright spots for investors? Let's bring in Brent Schutte, Chief Investment Officer at Northwestern Management Company. Brent, good to talk to you today. Does your base case change in any way based on what we heard from the Fed today?
No, I actually agree with Chair Powell. He said the base case is not a soft landing, even though the numbers they put out today look like a soft landing. Look, I don't think people spend enough time on the labor market, which is too tight, according to Chair Powell. To me, that means wages are too strong, and wages running at 4.5%, as he said in the last press conference, are not consistent with 2% inflation. And to me, the Fed wants wages to come lower, and the only way historically that has happened is through a recession. And so I guess in a long roundabout way, I still expect there's going to be a recession in the not too distant future, which I think will put a wet blanket on top of market gains. And that's where I think people should shift their focus more towards fixed income.
And Brent, can you just quantify that for us? When you say recession, economic downturn, when would you expect that to hit? And how deep and long would you expect that downturn to be, Brent?
I think it's timing uncertain. It certainly taken longer than what I think a lot of people thought, because there is excess savings. The consumer was in good shape. Corporations termed out their debt. And so I think the economy is less interest rate sensitive, but the longer this liquidity tourniquet stays on, the greater the chance there is a recession. And I don't think the Fed's going to take that off anytime soon, which to me means there will be a recession. I think it's likely in the next 6 to 9 months. That's where I think one is likely, but certainly a bit uncertain on the length of that. I think from an overall perspective, I do think it'll be mild just because of the condition of the consumer and the corporations, which I think are still in good shape. And so with that, I kind of believe you'll actually see a bit of a recovery on the other side that's pretty sharp too.
Brent, the comments coming today from the Fed certainly point to the uncertainty they're operating in right now in terms of where the economy is headed. But, you know, he was asked specifically about that soft landing case, and he said, look, some of that may actually be in factors that are not in our control. The UAW strike, you could argue, is one such risk that the Fed can't necessarily control. How are you looking at that playing out? I know we're approaching a week, still not a ways in, but how significant a risk is that?
Yeah, I mean, to me, it's more indicative of a tight labor market. And so you've seen wages run pretty hot, at least above where the Fed wants them to run. And the UAW strike is indicative that employees have some kind of bargaining power over employers, which typically happens at the end of every economic cycle. And that's what causes wages to rise. And I think people need to remember the period of time in this country in which inflation ran hot, 1966 to 1982, was called a wage price spiral, where wages kept going higher and pulling inflation back up. And to me, that's what the Fed is worried about. That typically happens at the end of every economic cycle, and that's where you're at today. And that's why I still see the Fed continuing to fight inflation until wages push lower. And unfortunately, the only way that has occurred in the past is through a recession. And I don't think this time will be any different.
And so, Brent, I'm also curious to get your take on oil prices, higher energy prices. You know, that was another theme for Jay Powell, talked about how higher energy prices, sustained higher energy prices, he said, are significant, can impact spending. How are you thinking about that risk?
Yeah, I mean, to me, that certainly is a risk on the inflation front. It's a risk because it also shapes consumers' expectations of inflation, which today, as the chair mentioned, are very anchored. I mean, you saw them come down last Friday in the University of Michigan survey. That's why I do think the Fed will be able to cut rates in the future if we do have a recession. One more reason why I think it'll be mild. But that is certainly a risk. If they stay high, people tend to believe inflation will be stickier, and that certainly is a risk moving forward. So from that standpoint, I think it's a risk to inflation overall, longer term, as I heard your prior guest, the former head of the Atlanta Fed, talk about. I think that's where the risk is, that they stay higher and that it filters more through the economy because it is involved in a lot of things that actually happen in the U.S. economy.
So, Brent, let's talk strategy. You say specifically you're overweight U.S. small and mid caps. What's the thesis?
Yeah, so overall, we are our preference is for fixed income. We are overweight fixed income relative to equities and commodities because we do believe there'll be a recession. And right now, the bond market, the Bloomberg aggregate bond market yields 5.25, which you haven't seen since 2007, and before that, 2002. And so yields are very attractive right now, especially if you believe there will be a recession. But because we believe it will be mild, and because I think mid and small cap stocks trade at cheap levels, they've already discounted some sort of a recession. For example, the small cap market trades at 13 times earnings have been marked down 15% already. That's where I think there's going to be opportunities on the opposite side. And so we're staying overweight those parts of the market that we think will do well through the recession and onto the other side, but while emphasizing fixed income right now, just because we do believe it'll be a hedge against equities downside in the next 6 to 9 months.
And what about international, Brent? Do you see any opportunity there?
I do think there's opportunity longer term. They trade at cheap levels also, but I don't think the recession that's going to happen in the United States is going to be avoided there either. And so our preference right now is clearly for U.S. small and mids, which typically don't do well at the end of an economic cycle. But this is where I believe the market has already discounted some of this. And that's where I think there's the most opportunity pushing forward. I think international stocks for a long-term investor make a lot of sense at multiples they're at right now. But I do believe in the coming few months they will have some difficulties also.
Yeah, some good takeaways there as investors try to make sense of the latest FOMC decision. Brent Chudy, Chief Investment Officer at Northwestern Management. Thanks so much for joining us today.
Thank you.
Well, good things apparently come in threes, and Klaviyo might be the surprise winner from the week's IPO boom. Instacart still down after popping on its debut on Tuesday, and chip designer ARM facing downgrade pressure again. We're going to bring you the latest on those calls on the other side.
Congress did end the student loan payment pause. Bills will be going out as payments are due in October. And we're really encouraging people to take a look at all of the affordable repayment options. We've created the SAVE plan, which is the most affordable repayment plan ever. We already have 4 million people in it.
The first thing we would advise any student or family that's managing student loan debt is not to wait. The time to be thinking about repaying your student loan debt is today, not waiting until the last moment.
President Biden and his administration is committed to taking action in order to relieve student debt. The president has also announced a Plan B under the Higher Education Act and will hopefully be able to provide borrowers even more relief.
Because we've had such a long break, a lot of people don't even know exactly how much they owe, who their lender is. And so for some people, it starts with answering those basic questions.
The cost of attaining a higher education degree has become unaffordable and unattainable. And so we really do need to look at common sense solutions, ensuring that states are able to adequately fund their higher education.
Women earn degrees at a higher rate. They're enrolled more in college. So they've taken on more degrees. They've taken on more debt. Then they emerge with a degree and they are earning less. And unfortunately, it takes them longer to pay off that debt.
The president is trying to put into place things that will help people who go to college. And we should be really helping people go to college and doing it in an affordable way.
I was a high school math teacher right out of college, and I got my first contract for $29,000 and thought it was like $1 million. For most folks, they know today that not that much, and you can't actually kind of afford to live off that money. Really kind of contributed to feeling a little bamboozled kind of by the system itself.
I think the number one thing is, generally speaking, we tell people not to fall victim to people calling you and asking you for advice. If it sounds too good to be true, it usually is too good to be true.
Everybody thought that student loans of all stripes persist through bankruptcy, but in fact, certain private student loans do not. And we brought a lawsuit to try to stop Navient from collecting on those loans for thousands of people, and we're successful.
What we're hearing from a lot of employers and from a lot of students are questions about mental health, about well-being, and student loan repayment is part of that conversation as they think about their financial well-being. So all of these types of benefits are becoming more the norm as a new generation comes into the workforce.
I think these are important questions that families are asking now when they're looking at the potential of taking on student loan debt. What's the long-term return on investment? And that's what folks are asking.
So the real question to ask
isn't whether it's good or bad debt, it's whether I can pay it back and whether it will be sustainable after I invest in myself.
We have a survey at Prince Review called College Hopes and Worries. The #1 survey for the past 7 years running has been concerned about assuming too much debt to pay for college.
For loan borrowers, they may not feel that the loan itself is worth it, but the education is.
The education is really important, but people are going to have to start asking, is it even worth taking out these loans because it's just so expensive?
And there you have it, the closing bell on Wall Street. A lot of applause here at the New York Stock Exchange as we round out what has been a very busy trading day with the Fed right at the focus there. We've seen the losses on the Nasdaq accelerating into the close, closing down more than 1.5%. The Dow down about 76 points, and the S&P 500 down 41. Treasury yields also certainly in focus today as investors continue to try and digest the decision coming down from the FOMC. This market check sponsored by Tasty Trade. Josh.
All right, well, let's take a look at some of today's top trending tickers. Shares of ARM closing the day in the red. It says their tough times are persisting as Cathie Wood is advising to stay away from the stock that's amid to too much emphasis on artificial intelligence. So this one is an interesting name, Akiko. So ARM, obviously, there were some questions about that. Skeptics didn't like the valuation. They didn't like the headwinds to growth, right? Obviously, we think of ARM, we think of the smartphone market, which is slowing. On AI, it's interesting because I was talking to tech analyst Patrick Moorhead. I know you know Patrick. Here's how he would put it. He would say ARM is a secondary player in AI. He says, listen, they're not NVIDIA, which of course, poster child of the AI boom. But he did point out that, you know, NVIDIA, which is with its new super chip for the data center, the GH100, that is a combination, he said, of NVIDIA's GPUs and ARM's CPUs. His point is they are a player, but maybe not enough of a player for Cathie Wood,
and that
apparently.
points to kind of why we have seen ARM now in its fourth straight day of declines. The initial pop we saw in the expectation that they were going to be a player in the AI game, but since then we've seen analysts initiate coverage with some skepticism. Cathie Wood, the latest to join in, but it really does point to what we have heard from Needham as well as Bernstein saying, look, it's not that we don't believe the AI story, we just haven't seen it. And we don't know how significant a revenue driver it's going to be moving forward. Instacart, also following ARM in the post-debut struggles, closing its first full trading day in the red. I mean, it's certainly too early to say where Instacart is likely to land in terms of where the company is. But, you know, part of this, Josh, is also trying to figure out where the competition is for the company. The company's talked a lot about sort of the ads now really driving revenue, but Instacart's still being seen as this grocery delivery company. What are these additional tentacles they have to drive revenue beyond their core business?
And Instacart itself says, I mean, it's a great point. They themselves say, listen, you got a lot of competition. Potentially, they called out everybody from Walmart to DoorDash to Uber, so there is a lot of it.
Yeah, let's move on to our next stock that we're watching. Shares of IBM higher today after RBC Capital Markets initiated coverage on the stock Wednesday with an outperform rating and a price target of $188 a share. Analyst Matthew Swanson optimistic on the competitive positioning and unique role that IBM plays in the tech ecosystem. You know, I was looking up this note, Josh, but really, in some ways, this is kind of an outlier, right? 28% of analysts still have a buy rating, but 67%
on the sidelines.
A hold.
No love for Big Blue.
No love for Big Blue, but RBC is saying, look, there's a bit of a misunderstanding of what exactly their software business is, and that's why it's largely undervalued.
Yeah, I mean, listen, IBM has not done much this year, right? It's up single digits, but if you're a bull, you say, great, it's underappreciated. And listen, there are bulls who they look at hybrid, they look at AI, they look at consulting, and they're fans.
Yeah, I mean, the stock getting a lift at least on one day here on the back of RBC's initiation. $188 a share, which implies 28% upside to where we saw it close on Tuesday.
Yep. All right, well, this Friday, moving on, the new Apple Watch Series 9 will become available to the public. It will run you about $400, the cheapest version. Yahoo Finance's Dan Howley got a chance to try it out. He joins us now. Dan, give us your review.
Yeah, not only did I get a chance to try it out, I actually have one on. This is the Apple Watch Series 9. Let me just, set this real quick. The new feature called Double Tap is essentially a way for you to navigate the phone or parts of the phone with one hand. And this is a version of the Apple Watch that has that software installed. So it's an early version. The actual software, though, won't be available for watches until next month. So you're going to have to wait a sec. That's my gorgeous looking wrist right there. And so let me just show you how it works, because this is clearly the marquee feature for them. If you have the watch on, you just tilt it toward yourself, and then you'll be able to just quickly double tap your fingers, and it will automatically show up. So if I go, there we go, we'll go over here, or this way, that way, there it is, all right. So I don't know if we can get close in on it, but it might be a little hard to show. What you do is you just tip the watch up to you, light up the screen, and then you double tap, and you can see that it brings up the smart stack there. You can see it kind of moving. And I'm basically just, doing this weird double tap feature. I got to say, it's really cool for a number of things. One, if you're cooking and you have a timer and your hands are covered in chicken goop, it's great. You don't want to touch your watch with, chicken germ hands, or you got making an omelet. A lot of chicken-based cooking going on in my apartment, but regardless, it's an easy way to silence the alarm. You can also pause and unpause music. You can also change that so that you can move forward, skip a track as well. If you get a text message, really cool is you can double tap and then begin talking, and you'll start transcribing a text, and then you can fire it off by double tapping again. So they've added a number of capabilities to this. You can't navigate the whole phone with it, watch with it. That's not the idea. It is purely for specific apps. But when you're able to take advantage of it, it really is a great addition to the watch. Beyond that, they have the new S9 chip with the neural engine. That's really what's powering this. They also have, I mean, one of the best features for the Apple Watch is your ability to locate your phone. Usually it's between my couch cushions, buried, next to a White Claw or something along those lines. You go to your watch, you do your little bell that'll ring off your watch and your phone, and you'll find it. With this, though, you'll get precision location. So it'll show up on your watch and kind of guide you to it with a little arrow saying, go in this direction, you're 4 feet away, you're 3 feet away. And as you get closer, it'll say, okay, you're here, here's your phone. So if you can't hear it because it's buried deep under those couch cushions, it'll be able to show you where to go. So it's super, super helpful in that respect. There's also a brighter display this time around, though I haven't been able to notice too much of a difference from the Series 8 that I have compared to this. It's really, you got to be out in direct sunlight. And those are really, I think, some of the main things to look at when you're looking at this watch. My one issue...
Dan, I'm laughing. I'm laughing because I use that locator like every 5 minutes.
Constantly.
In my apartment. But I don't know, this move. Am I the only one that thinks it's sort of weird that we're going to have a bunch of people just doing the double tapping? All right, let's move on. Another product here. The iPhone 15 Pro and the Pro Max, also available on Friday. You're looking specifically at this focus on gaming with these phones. What's the reason behind that?
Yeah, so there's really, kind of a push by Apple to ensure that they are thought of as a gaming go-to for mobile phones, right? If you look at Android devices around the world, a lot of them are used for gaming, and in particular in Asian countries. In China, they didn't have consoles. There was a ban on consoles for a while, and so a lot of people went to PC gaming, and then because smartphones are cheaper than buying a PC, and you can play games on them relatively easily, mobile phones became really where a lot of people play. And so when you look at the event that Apple had, they made sure to point out the gaming capabilities of, in particular, its Pro phones. And specifically, they said they can run console quality games. Now, that's a big thing to say, right? I have a PlayStation, an Xbox. How is my iPhone going to live up to that? Well, they say it's because of their A17 Pro chip, and that they can run these games natively on the phone, meaning it's not coming from the cloud, it's not going to be from your Mac to your iPhone, it's going to be on the phone. And they have new games that are running on it. Ubisoft's Assassin's Creed Mirage is coming out for consoles. It will then, early next year, be on the iPhone. You have Resident Evil 4, the remake, as well as Resident Evil Village. Those are two big games from Capcom. Those are playing on it as well, and I've seen it, and it works well. This isn't, some kind of janky fly-by-night version. These are real versions of the games. The problem for Apple, though, is that they have to get developers to get out there and build games. You're not going to be able to play those games on an iPhone 15. It's only the Pro. So when it comes to developers and publishers, they have to make that decision on, is it worth devoting resources so that people can only play on two phones? There's the higher price of the phones, yes, but Asus has a game a phone that's $1,300, $1,400, specifically for gamers. So there is an appetite there in certain areas of the world. Like I said, Asia comes to mind because that's where a lot of the gamers are. But for Apple, it's going to be an uphill battle for people to really go out and say, I'm not going to get my PlayStation, I'm going to get an iPhone.
All right, Dan Halley, thank you so much for that. That was great, so we appreciate it. And FedEx is out with first quarter earnings, the company raising their outlook, shares rising on the report. We'll bring you the results after the break.
Well, we are watching shares of FedEx getting a big pop in after-hours trading here, up more than 5% after the company's first quarter earnings report. Earnings per share beat estimates, coming in at $4.55 a share. Estimates were at $3.73. The company has reported $21.7 billion in revenue. That's a slight miss from the expectation of $21.84 billion, coming in well above the street estimated $21.81 billion. The company also raising their guidance. We're going to bring down, let's break down the latest results with John Eade, who's joining us from Argus Research. John, your immediate reaction to the numbers that we just got today? Street certainly liking it, at least on the initial pop.
Right. I think we're seeing some incremental improvement, maybe not necessarily on the top line, but on the bottom line with management's focus on improving margins. The street was looking for better earnings growth, and that's what they're getting here today.
And John, you know, some analysts, your colleagues on the street, they were talking about the volume environment they described as kind of so-so and tepid. And that makes sense given some of the macro challenges, slowing imports from Asia, weakness in Europe. How do you see it, and what does it mean for FedEx?
Well, that was one of the things I was hoping to see was better volume numbers from FedEx. That didn't happen. I think last quarter, the FedEx volumes were down 7%. This time they were down 9%. FedEx is still getting some price help. That's a good thing. But the real story here is the costs that they're taking out of the system. And when the volume does come back, and it will come back, right? This is a cyclical business. Global growth will pick back up. If they can keep those costs low, they're really going to see some profit margin leverage when the volume does return.
John, we saw a lot of businesses migrate over to FedEx in the initial anticipation of a potential UPS strike. Certainly, FedEx coming out the beneficiary of that. There was also the bankruptcy from Yellow. But when you think about where the labor costs are right now, how, as an analyst, are you looking at it in the context of FedEx? Yes, things came over from UPS, but UPS coming out of this with workers seeing those higher wages, you know, what's the pressure now that shifts over to FedEx?
Well, that's a great question. And UPS has a history of being a lot more profitable than FedEx with higher margins. For example, UPS's margins are typically in the mid-teens range, and FedEx has set an aspirational target of 10%. So I think what FedEx is trying to do is use data and technology to offset these labor costs and do a better job of flying the right aircraft and lining up the employees when the volume is weak or when it picks back up. None of these transportation companies, whether it's Yellow or FedEx or Old Dominion or UPS, can do very much against these higher labor costs. That's more up to the Federal Reserve, and it looks like there's another hike coming, so maybe that will help.
And John, I'm interested to get your take as well. Listen, this name was running hot into the print. It was up about 40%, more than 40% so far this year. We're tacking on around another 5% in the after hours. How does valuation look to you, John, at this point?
Well, FedEx has done very well over the past quarter against its rival UPS and against the broad market. It's done pretty well over the past year, but it really has suffered over the past 5 years. And that has to do with the pandemic, that has to do with cyber break-ins that they faced, that has to do with trade wars. So FedEx was very much beaten down. And even though they've recovered a lot this year, their PE ratio is still lower than UPS. Their price to sales ratio is still lower than UPS. Their yield isn't lower. UPS has a very attractive 4% yield, but the FedEx yield of 1.9% is still richer than the broad market yield. So that signals value too. So despite this pickup in the price this year, I still think FedEx is a good value. And I'll be revisiting my target price when I update the earnings model.
John, we're going into the year end here, what is typically a very busy time for the FedExes and UPSs. Where do you see those volumes going as we look to the holiday season? And there's questions around, whether in fact, at least from a consumer standpoint, we're going to see the same kind of pickup.
Right. So last year, I think overall holiday sales grew at about a 5% rate. It was a good year last year. I don't think the growth is going to be as strong this year. Maybe more like 3 to 4% growth in holiday sales. But the e-commerce share of those holiday sales is going to continue to grow at probably 2 or 3 times the overall rate of sales. So I do think that's going to be good news for volumes for FedEx and for UPS. Their challenge, of course, is not over hiring, but not under hiring either, because nobody wants their presence late. But that's always the big issue for the upcoming holiday season.
John Eid with Argus Research. Good to talk to you today. I appreciate you stopping by.
Okay. Thank you, Kiko.
We are rounding out our Magnificent Seven series, and what better way to end than with Amazon? The company has been making efforts to improve profitability. This year, it certainly paid off. Shares are up more than 70% year to date. After investing aggressively in the early part of the COVID pandemic to meet soaring demand, Amazon has worked to rein in some of those costs in 2023 through layoffs and efficiency measures. Let's bring in Ali Garfinkel on where the street stands on the stock. Ali.
Kiko, Amazon's really walking a tightrope here. They're really trying to balance efficiency and growth moving forward. They really soared during the pandemic. They were meeting this generational demand, and they expanded accordingly. And what's happened is they've had to cut back very, very publicly. Layoffs, cutting programs, you name it, Amazon's done it. But on the bullish side, there's a lot to be pretty enthusiastic about here, analysts are telling me. Number one is the e-commerce business and its incredible resilience. Yes, they have to still keep working on improving those margins, but it's proven to be a really attractive offering for consumers. In this sort of stilted macroeconomic environment, data is really showing that, frankly, a lot of people are still buying their pasta, their paper towels on Amazon. It also doesn't hurt that Amazon has been the best e-commerce stock performer, and they do have a pretty astonishing market share when it comes to e-commerce. Right now, Amazon has a grip on about 37% of the e-commerce marketplace, and this is pretty jarring. Walmart, their next closest competitor, comes in at 6.3%. So there's a lot of optimism coming out of e-commerce, but there also, as they've sort of been cutting back, there is starting to be a lot of optimism on where Amazon's valuation is at. Now, what do I mean by that? A lot of folks are saying that Amazon stock is undervalued right now, some saying by about 10%. For my part, I don't quite know what to think of this, Akiko. One of the things I find most interesting and infuriating about Amazon is this question of valuation, because there are so many parts of the business and they're all so different that it's really difficult to find the sum of those parts.
Okay, Ali Garfinkel rounding out the Magnificent Seven for us today. Thanks so much for that. Let's do a quick check of the markets sponsored by Tasty Trade. Red arrows across the board at the close here, with the Nasdaq down 1.5%, the S&P 500 down about 41 points, and the Dow down 76. All this coming on the back of that FOMC decision and the updates on the summary of economic projections. Checking in on the fear gauge, we are taking a look at the VIX, elevated today on the back of this Fed decision. You heard Jared Blicker yesterday saying that this is kind of the time where we start to see a spike. And today, 6.5% up here at 1504. Well, Klaviyo shares closing the day in the green. We had a chance to speak with the CEO earlier today. We're going to bring you that interview on the other side.
Klaviyo, the software marketing company that helps brands better target customers, think through email, through text, going public today on the New York Stock Exchange. And I want to bring in the CEO and co-founder of Klaviyo. We have Andrew Bielecki here joining us from the floor. Andrew, first off, congratulations. Huge day for your company.
Thanks. I'm just so proud of the 1,500 Klaviyos all over the world, our 130,000 customers, brands like TaylorMade, Unilever, Skims, 5,000 partners. We've been building for a decade. We are just getting started, but today's a huge milestone.
Certainly a lot of questions going into this public debut when we talk about valuation questions, when we talk about the ability to get some of those bigger name investors on board. You've done that. What's your message to investors and maybe some of those out there that aren't as familiar with Klaviyo?
Sure. Well, at Klaviyo, we believe that every company should have smarter digital relationships with their customers. That's a super durable trend. We're a very long-term oriented company, and so that's one. And then two is we just believe in being disciplined in how we grow. I think we believe in creativity, and the constraint that constraints really force creativity. So I mean that's what our company's all about: is aiming long and then just executing really well.
Turned profitable in the first half of the year, net income of just around $15 million. Are you confident you're going to be able to stay profitable?
We'll see. Won't look forward right now, but I mean, we've just that discipline in the way we think about building, getting close to customers, getting close to partners. I think that's how you build great businesses.
You founded Klaviyo just over 10 years ago, back in 2012. I'm curious, before we talk about your customers, from the targeting standpoint, when you take a look at the consumers out there, how have the consumers' needs evolved over the last 10 years?
Sure. Well, consumers definitely, they want the businesses that they work with. I mean, that they buy from, they transact with. They want those businesses to know who they are. I think we've all gotten messages or had these experiences where it felt totally unpersonalized, just generic. That should be better. And what we found is the businesses want to deliver that because they know customers love personalization, and that's what gets them to buy more. Just the tech was missing. So that's what we've been trying to build and what we've built. And I think a little bit of proof point. We've got everybody from entrepreneurs just starting out, small businesses, now moving up into the enterprise. I mean, we think there's a lot of customers out there that should be running on Klaviyo.
And I believe you do it through predictive models of consumer behavior, right? So how much of that are you relying on AI for that part of the technology?
Definitely. So machine learning, artificial intelligence has been core to our strategy. I mean, really for the last 5, 6, 7 years. I think if you look at a lot of, we'll just take marketing as a space, you have to be a really talented marketer, and you're still experimenting to figure things out. Every customer I talk to says, Andrew, what ideas do you have that I'm maybe not thinking about? Well, the good news is you can use artificial intelligence to not only generate content, but help come up with those ideas. I think in the future, we're going to build software that is good at using itself. So in this case, the marketing software, literally, you plug your business into Klaviyo, it'll develop your marketing strategy, and if whatever your growth goals are, it'll build that optimal path to help you get there.
So should investors be thinking of Klaviyo almost as an AI play?
Yes, I mean, we think about it as we've built the data infrastructure to store all your data, the applications, the marketing software to connect with those customers, and then it's really artificial intelligence that brings it all together so that even if you're not a great marketer or you want more advice, you can get that automatically with our software.
And Andrew, your customer base right now, just over 130,000. When you take a look at that future growth, what do you think is going to drive that, and who are you targeting, where are you targeting?
Sure, so we look to, honestly, we try to delight our customers, and then we know that they talk. Actually, a lot of businesses, you can grow virally. So we're going to continue to lean on that. We have wonderful partners. We're excited. We're getting, larger and larger brands are coming and saying, hey, I want to standardize on Klaviyo. We've opened offices in London and Sydney in the past few years. We're excited to expand globally. There's a lot to do.
Your international exposure right now, I believe as a percentage of your revenue, right around 30%, right around a third. What do you hope that looks like 5 to 10 years from now?
Yeah, I don't know. International is a really exciting market. I've spent a lot of time just traveling in Europe and in Asia, understanding how businesses there work. How often I'm surprised that they're just as driven as the companies that are maybe in our hometown of Boston. I don't know where that ends up, but I'll tell you there's a lot of growth there.
When you talk about some of your customers there, and I was going through your S1 filing, nearly 80% of your company's average annualized revenue coming from customers of Shopify. Some are saying that maybe that could be a potential risk here. What's your response to that?
Oh, we're not worried about the risk. I have known the Shopify team for a long time. We love working with market-leading platforms, and they're definitely a market leader. We're excited to work with more of a Shopify and platforms in other verticals outside of retail and around the world.
Andrew, great to have you. Thanks so much for making the time.
Thanks so much.
Let's take a look at Klaviyo's shares after its first official day of trading. The stock popping 9% on its debut. As you just heard there from the company's CEO, it is an exciting market for IPOs currently, with big ticket names like ARM and Instacart also going public in recent days, but each have seen a pop and then a drop in this high rate environment. Is it the right business choice? Here to break that down is Nick Einhorn, Capital Research Director at Renaissance. So Nick, let me start with this. So ARM, Instacart, Klaviyo, how important are those names to the IPO market, Nick? Because we hear about them. A lot of people say, listen, these are barometers. You buy that?
Yeah, for sure. We've seen very few tech IPOs for the last 2 years. A couple names like Mobileye last year, but for the most part, it's been pretty dead since 2021. And so I think it's important for the tech IPO market, certainly, but the IPO market generally, to have some bigger names come out and to see how they do.
Looking, Nick, at the Renaissance IPO, always a good gauge of where sentiment is right now. You said that part of the reason we're starting to see more of this pipeline coming to market is because investors are starting to take more of the risk. I mean, beyond what we saw this week, what's in the pipeline that points to the fact that there's more appetite?
Yeah, for sure. The pipeline is still pretty quiet just because a lot of companies are out there waiting to see how these deals do, what happens with the Fed and everything. But we know there's names like Turo that filed last year, looks to be poised to be coming again at the end of this year. Birkenstock filed a few weeks ago, a big consumer name there. And yeah, certainly the IPO index does show that valuations in the tech sector, but other sectors as well, have been improving this year. Definitely very strong in the first 8 months or so of the year. Things came down a little bit since then. But we're definitely seeing, I think, improved sentiment towards recent IPOs. A lower VIX is always good for IPO activity, which we have seen over the last few months. So there's definitely a lot of good indicators for future IPO activity.
And Nick, just playing off the sentiment issue there you raised, and when you look at the reception the names have gotten, ARM and Instacart, it's been choppy. I mean, what does that tell you about risk appetite right now, the reception they've gotten as they make their public debuts?
Yeah, it's definitely been a little bit of a choppy reception. They've all kind of traded down from their first open. And I think that goes to some of the skittishness in the market generally, obviously with the Fed meeting this week and the potential government shutdown. But also I think it just shows that IPO investors are still not totally convinced that the IPO market is back. They're a little jittery. Maybe some of them are taking gains early once these companies price up. But on the flip side of that, I think the fact that they got healthy receptions, they priced at the high end of the range for ARM, raised the range for Instacart and Klaviyo. That does show that there is demand for IPOs out there. It's just a question of maybe follow through with the aftermarket trading.
And Nick, follow on that. Where is the appetite right now? Is it about companies that are growing with profitability in mind? We've heard for a few years now that it's not just about sort of growth at all costs. And if that's the case, I guess the second question for me is, what is in the pipeline? Those companies that have massive valuations on the private side of things, do those fundamentals match what investors are looking for in the public markets?
Yeah, and valuation has been what's held back the IPO market to a large extent the last few years. We've seen a company like Instacart is a good example, coming public at a valuation in the 10 billion range, whereas it was privately valued at around 40 billion a few years ago. I think there's a recognition that those kinds of valuations are off the table for now. They're not coming back anytime soon. So a lot of companies like Instacart have had to reckon with that, on their own before coming public. And then, yeah, the growth has slowed for companies like Instacart, but they've shown a lot of progress on first reaching profitability and then improving a lot the last year. And I think that's a similar game plan that we're going to see from other future tech IPOs. Klaviyo is another name that kind of reached profitability or at least break even-ish this year. And that's going to be important that they can demonstrate that they're going to be profitable going forward. And then ARM, of course, a very well-known name, large company, strong market share, very strong margins. So investors definitely want to see a good story about long-term growth, long-term margins. They're not just looking for kind of any hot thing at the moment.
And in part, Nick, is that a function of just, listen, there are alternatives for investors right now? I mean, folks are looking at T-bills and muni bonds. They're looking at money market funds yielding 5%. Is that why you think some investors are saying, listen, if you're going to go public right now, show the growth, but also show us a decent bottom line?
Yeah, I think so. And the flip side of that is there aren't a lot of IPOs, so IPO activity or IPO investors have been somewhat starved for activity, but they're still going to be very choosy. They're not going to, it's not going to be like in 2021 where you wanted to be in every single IPO just in case they all popped 100%. We're not in that market environment anymore. And so these companies are definitely going to have to convince investors, of their long-term plans, that they make sense, they have a good competitive moat and all that. And we've also seen cornerstone investors in these deals, in all three of these deals this week, showing that, public investors want to see that there's some other big names who are committing capital on these IPOs.
And Nick, what's the next big name that you're looking to really test the market? You mentioned Birkenstock. I mean, what are some other names that you think could really be sort of add to the momentum that we have seen?
Yeah, Birkenstock could launch next week. I mentioned Turo. There's some other software companies out there like Waystar, Rubrik, Rocked, and certainly Klaviyo, I think, is a good indicator of software IPOs, which were a big part of the market 2-3 years ago, and we haven't really seen since then. So that could be an important sector to come back at some point.
Nick Einhorn, Capital Research Director at Renaissance. Thank you so much for your time. We appreciate it.
Thank you.
And coming up, requirements to return to office can be damaging to a key part of the labor force. We'll bring you the details on the population it could affect next. A growing number of companies are cracking down on bringing workers back into the office. The push of getting employees on site, putting pressure on moms in the workforce. Here with a breakdown on the potential ripple effects to the labor force, we have Yahoo Finance's Carrie Hannon. Carrie.
Hey, great to be here. Yeah, this is a big issue that's coming up. I mean, my gosh, the first half of the year, women with children were, about a quarter of working women were working, full time and in the first part of this year. I mean, it's an enormous statistic as more women have jumped back into the workplace post-pandemic, and now are at all-time highs, women's participation in the workforce. And that's been great news in many ways for the economy and everyone along the line. But we may very well see women hitting the sidelines once again who have child caregiving duties as well as adult caregiving duties. I mean, this is an issue where you absolutely need flexibility. And as we've seen coming through this summer, employers are saying enough already. They're mandating people get back into the office. And the whole key
Okay, Carrie Hannon, it looks like we're having some issues with your audio. Thanks so much for bringing us that report. Well, the United Auto Workers Union is fastly approaching nearly a week of its strike. As negotiations continue, the Biden administration finds itself with two very conflicting agendas. While President Biden advocates for well-paying labor jobs, car makers are saying they're struggling to meet those demands because of the investments that are needed to transition into all electric vehicles. I sat down with White House National Climate Advisor Ali Zaidi for more on the administration's agenda and where they see the climate agenda moving forward.
No, I think the president's been really clear. We see record profits, and that should translate into record contracts. I think longer term, here's what I see. Number one is the price of the core technology continuing to come down. Lithium-ion batteries in August reduced prices by 9% month over month, 31% year over year. And we continue to see improvement on that cost trajectory. We're seeing more and more investment pack into this transformation. The U.S. is now the number one nation that's attracting capital into this transformation, over $210 billion committed against this objective. So I think there's a lot to navigate as the transition takes place, including building out charging infrastructure, having the supportive, resilient supply chains. But this is a road we can travel. We can travel it together. We can travel it in a way that produces not only electric vehicles, but good-paying union jobs.
You've heard the UAW workers say before, the concern with the EV transition is that these cars don't require as many workers. At the same time, you've got other jobs that are being created with batteries moving forward. How do you get the buy-in from particularly labor unions on this EV transition when they have spent decades building ICE cars?
You know, we have the best workers in the world. That's part of our competitive advantage as a country. As we write this next chapter of the automotive journey, we've got to invest in those workers, and we've got to bring them into this broad supply chain. There's a whole industry that stands behind that final assembly. The input materials being sourced from states all across the country, the batteries, and frankly, before the batteries even, the input materials that go into them, the anodes, the cathodes, the raw lithium supplies, and others. And in all of those, we have an opportunity to not just deliver the product, but have this be a moment of uplift for workers and the American middle class. So that's how we're focused, is how do we win as much of the finish line as possible, not just put electric vehicles on the road, but have them be stamped made in America, with products sourced in America, with workers who are being paid good wages, good benefits, and have the right to bargain.
Let's talk about where oil is right now. We're quickly approaching $100 a barrel. When you think about oil production under this administration, we're reaching record levels. At the same time, you've got, with you leading the way, the administration talking about this transition to net zero, away from fossil fuels. How do these two agendas move in tandem when there is pressure on the administration to act in trying to bring gas prices down?
Well, we've got to walk and chew gum at the same time, to use a bit of a cliche. We've got to meet the American consumers where they are. There are people who have to pump up gasoline to get from point A to point B. We need to make sure that they are not absorbing either the cost of Russia's aggression in Ukraine, which has impacted dramatically global markets, or corporate profits and inefficiencies that are being subsidized by consumers. So we've got to make sure that that we're meeting that demand. The president's used extraordinary tools, working with allies and partners, releasing on a strategic basis reserves of petroleum to stabilize the market, working to make sure there's adequate supply. But he's been clear all along that the path to energy security, to consumer energy security, is shifting to clean energy. You look at the volatility of global oil prices and motor gasoline over the last 20, 25, 50 years, and you look at the volatility of electricity prices on the retail side over that same time period, and it's two totally different stories. One, we control our destiny because we generate that source of energy here at home. It's not traded on global market. Those wires that carry electricity long ways don't reach overseas. And they produce electricity cleaner and more efficiently to get folks plugged in. So whether it's hydrogen or it's battery electric, hybrid, there are strategies here for us to boost energy security, consumer energy security, and we're chasing after that.
Let's talk about the conversation that's been happening on the ground here during Climate Week. We heard from Treasury Secretary Yellen talk specifically about the economic risks that stem from climate change. You know, I think the number she quoted was $3 trillion in terms of what needs to be invested to get to that net zero goal in 2050. And yet, when you think about the big companies, there feels like there has been a shift, at least in the public declarations, in how committed they are because of the backlash that has happened politically. What are you hearing behind the scenes?
I think what we're hearing behind the scenes is that smart money is still chasing climate solutions, and that we've got to find ways collectively to get that capital to flow volumetrically more significantly and to flow faster.
Have you seen it accelerate?
We have seen it accelerate. If you look at just what's happened in the last year since the president signed the Inflation Reduction Act, $240 billion of capital has been committed to expanding clean energy deployment and manufacturing here in the United States. 100 new factories and counting to manufacture those products here in the United States. Projects the size of the Hoover Dam repeated on a regular basis in terms of imagination and then steel in the ground here in the U.S. So I think the trajectory is very clear. We know what the solutions are, and the opportunity is massive. So I think that's why folks are chasing these solutions, whether it's the private equity and the venture capital funds who are making the bets with their capital allocation, whether it's the lenders in this space figuring out new ways to underwrite based on the technologies and the market demand, or it's the corporates who are stepping up and taking action. But we need a lot more of it, and we need a lot more of it right away.
That was White House National Climate Advisor Ali Zaidi. Interesting on that last point, Josh, where he was talking about businesses that are still investing. He said, the money is actually accelerated going into this transition into clean energy. Because when you think about what the conversation has been among the businesses, but particularly around these large funds, BlackRock is one that comes to mind. It has been about them backing off of their public declarations for ESG. Larry Fink earlier this year said, I'm not going to use the word ESG anymore because it's weaponized. And yet Ali Zaidi is saying, look, that money, though, is still flowing. It's just being called something else because it has become so political.
Yeah, I mean, that was an interesting part of the conversation because it has been so politicized. I mean, you have Republican governors, Republican attorneys general. They are on the march against these companies that they see and these CEOs that they see as spokespeople for the ESG movement, which they see as just kind of playing cover for climate change politics. You have states moving in, Texas, West Virginia. So that dynamic that he was discussing was fascinating there.
Yeah, of course, we're talking about this in the context of UN Climate Week. So much of the climate protests, the climate discussions, all centered here in New York City this week. But this is all kind of a preview of what's to come in November, which is COP28 in Dubai. And already there's a lot of rumblings around that, largely because the UAE is going to be hosting it. There's an argument to be said. We're talking about climate. Why are we going to a region that is the big fossil fuel emitter? But that's going to be an interesting conversation because the U.S. is coming in with the IRA saying, look, we have put this template for you. We have been able to bring all the investments in. There's an economic case to be made in this transition. We'll see if the other countries follow. We know at least the EU has put forward their subsidies as well.
When you pushed him, Akiko, on the UAW, were you surprised by his response there?
Well, he's the national climate advisor. He's going to be pushing for this transition to EV to say, we can bring people along. It doesn't have to be one or the other. Of course, the UAW has shown they're very skeptical, at least for now, because they've seen with this transition to EVs, companies are having to invest more. They see how EVs are made. That's fewer employees or fewer hands involved. They're worried about their future moving forward.
All coming, as you mentioned, UN Climate Week. What are some of the politics there between different nations when it comes to the issue?
Well, there's a lot between developing countries as well as emerging economies. This is sort of in the dynamic that has been ongoing. The biggest emitters, the developing countries would argue, aren't necessarily paying for the transition that needs to happen in those regions that are seeing the biggest impact. Right? Their argument is, look, we didn't cause this, you did, you need to pay for that transition. So it's going to be an interesting conversation moving forward as we look ahead to COP28. Well, coming up, it is closing time at Yahoo Finance. You don't have to go home, but you can't stay with us. We're going to bring you everything you need to know to end your day. That's coming up on the other side. It is closing time here at Yahoo Finance. Let's get you caught up on the top stories of the day. The Federal Reserve holding interest rates steady at a 22-year high on Wednesday, while signaling another rate hike will be needed later this year to bring inflation back down to that 2% target. Klaviyo shares jumped 9% in their NYSE debut. The marketing automation firm closed around $32 a share in their inaugural day of trading, compared with the IPO price of $30 a share. Both Arm and Instacart saw strong debuts in recent days, but they have given back most of their gains following their first day pops. And the Biden administration has announced it will forgive nearly $37 million in student debt for more than 1,200 students who attended the University of Phoenix. The Department of Education says that the school's national ad campaigns misled students into thinking the school's partnerships with Fortune 500 companies would improve their job prospects. The money will go to many borrowers who applied for the Borrower Defense Program between 2012 and 2014, which allows borrowers to prove they've misled or defrauded by their schools and get their federal student loans avoided.
And time now for what to watch on Thursday. Olive Garden's parent company, Darden, set to report their first quarter results. Analysts expecting $2.7 billion in revenue and earnings per share of $1.74. Investors will be looking to see if the company will report another beat after topping expectations for the past 3 quarters. And on the economic front, existing home sales data for the month of August, that is out at 10 a.m. Eastern time. This coming as sales in July saw a 2.2% drop. And meanwhile, inventory availability and mortgage rates remain unfavorable for home buyers. And last but not least, tomorrow morning, Yahoo Finance will be sitting down with Esther George, former Federal Reserve Bank of Kansas City CEO and president. So be sure to tune in to hear what George has to say on the future path of rate hikes.
That does it for Josh and I on this Yahoo Finance Live. We're going to be back here at the New York Stock Exchange tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. See you then.